the YouTube or it may be in the WhatsApp groups and all those things, because I don't go by the number. I don't want the 1,000 or 2,000. Even at the 100 serious participants are enough for me to learn something from this workshop. Because of that, we are not entertain the only producing the certificates to the uninterested candidates or non-interested candidates, but because of that, we are not posting attendance and other things in the WhatsApp groups and other things. So we are giving only to those who are actually attending this program. Only they are listening, but try to give the certificates for them. So because of that, we are not entertaining any such type of the bogus certificates issue and all those things. So because this funded the program by the ROSA 2.0. So because of that, we don't want to waste the money. Just like that, we are producing the certificates and giving to the 1,000 people and showing in my profile. That is not my criteria. Okay. Yeah. Thank you once again for registering this workshop for a 7-day program. Out of that, already the 3 days are finished. So I was not yesterday. I could not attend for 2 sessions as a director because of I also appointing as a trainer for the presiding officers of GHMC elections. So that I was busy yesterday, so that I couldn't attend. So, but I am also the participant. I am also learning something from this workshop. So along with the participants, we are also participating and we are also listening the program and learning something from this workshop. So thank you to all. So let's come to our subject, that is today's the tax planning, because everybody knows that already you learned about the last 2 days. We learned about what is income, what is SSC, what is the assessing officer, and what is called heads of income, and how to compute the heads of income and total income. Like that, what is the how to set up the carry forward of losses, maybe like how to pay the advance tax and how to conduct TDS and all those things. Already you learned from the last 2 days. So today we are going to learn about the tax planning. The 2 sessions. First session is the tax planning, and second session is the investment avenues in terms of tax perspective. And the third session is the last session for income tax, that is called e-filing. Which is important. The session that is called e-filing. So in this particular sense, the tax planning, everybody, you know that either is the direct or indirect, all the, including the participant, me or any other person in India, directly or indirectly, everybody is paying the tax. Suppose you buy the pen for 5 rupees, in that there is a GST. You buy the dress, there is a GST. Okay. Even you are not paying, some people are not paying directly from their pocket in terms of income tax, but they are paying the tax in terms of GST or in other indirect tax earlier. So like that, they are paying the taxes. So always, whenever you buy, suppose you buy the some costly item, suppose you buy the TV, they are showing that the TV cost is 30,000 and the tax is it may be 4,000 or 3,000 rupees, like that. You buy something 100 rupees, they are adding some 10 rupees or 15 rupees as a tax. Always, whenever you see the bill, always you will get some think, why should we pay the tax unnecessarily? The cost of the product is maybe 100 rupees, but I'm paying 120 rupees unnecessarily. Or it may be the cost of product maybe 30,000 or 1 lakh, and we are paying something. As individuals, also sometimes, why should I pay if I'm earning because of my knowledge, my experience, and all those things. I am earning the things, but why should we pay the tax? Because the tax is nothing but within the legal framework. Everybody has to pay the tax. So in this thing, just I will share the PPTs regarding to this. 1 second, just I'm sharing the screen.
Yes, okay, sir.
Okay, what is this? Sorry. One second, Venkatesh. Stuck in.
Okay, sir. Okay, sir. Karthik sir, good afternoon, sir. Sir, 1 second, sir. I'll make you.
పోస్ట్ అది ఒకటి పోస్ట్ మనం వెంకటేశ్వర ఇంకా
Itlan, sir. Know your course, sir.
ఓకే
Now you can present your screen, sir. Okay.
share అవుతుందా వెంకటేష్?
అవుతుంది సార్.
హలో
అవుతుంది సార్.
హలో
అవుతుంది సార్.
వెంకటేష్ షేర్ అయిందా?
ఓకే సార్. ఓకే.
అయిందా?
స్టార్ట్ ప్రజెంటేషన్ సార్.
నా వాయిస్ వస్తుందా?
F5.
Is it audible? వెంకటేష్,
Click F5 sir. Press on F5.
It's audible.
వెంకటేష్, is it audible?
Yes sir. Yes.
I'm not able to hear.
You maximize the screen.
Is it audible, my sound? My voice is there?
Yes sir.
Okay,
Yes.
right. Yeah, coming to this,
Start presentation sir. Presentation
this
start.
regarding to tax planning, just we will go one by one. Yeah. So here you know that everybody wants to try to reduce the tax, or within the legal framework or without the outside the legal framework. There is nothing which hurts more than the payment of tax. Everybody they feels that it is a burden to pay the tax. So just to see that this observation, so like that taxes are access, nothing but that. Suppose if you are earning something, so we are going to they are going to cut something from our income. So like that, that's why everybody feels that the taxes are excess. So because of how to reduce this tax burden by the SSCs, that we are going to learn from through this tax planning. So you have to plan ourselves to reduce our tax burden. So because only the legal evidence is acceptable, but illegal things are not acceptable as per the Income Tax Act. So suppose if you plan the tax regarding to how to that's called you plan such a way to reduce our tax burden, our tax will become lighter. Suppose if you are not planning anything, just like that you are earning and sharing the things, so your tax burden will be more. What is meant by the tax planning? So in that case, it is an arrangement of one's financial affairs to avail exemptions, deductions, concessions, rebates, and reliefs which is permitted under the Income Tax Act. So nothing but the tax planning is nothing but suppose you are earning something. So you know that the basic structure of the calculation of income tax, suppose we have the five heads like income from salary, income from house property, the capital gain, profession from business of profession, income from other sources like that. You take the aggregate of all things, you will get the gross total income. Gross total income, you deduct some deductions, and ultimately you are going to get the taxable income. So that all even you know that everybody knows that particular procedure, but within the legal framework there are some exempted incomes are there. There are some deductions also there that you can reduce by contributing something or maybe purchasing LIC and all those things, or can avail some rebates and reliefs like that. So that is nothing but tax planning. So whatever you are earning, so you plan such a way, automatically you are going to reduce your tax burden. So normally this is how we are going to calculate the tax liability on the basis of all the five aids and GTI deductions, taxable income, tax liability, ultimately net income. How we are going to plan the tax regarding to this one. So this is called income from salary and all these things. So in the different manners you can share this tax planning. Either can plan the about the tax regarding at the time of earning itself. You can plan your like investments and all those things, or after the earning at the time of deductions you can take the deductions after planning the that's called investments and all those things. So this comes under either it may be tax planning at the stage of income from salary, or income from house property, profits and gains from business or profession, or capital gain, or income from other sources, and gross total income. After that, deductions also there is a part of the tax planning, and ultimately tax liability comes under the tax management. So what is tax management? Again, we will discuss later. But tax planning in the sense, suppose you are earning something, you are earning in terms of salary, you are earning in terms of house property, you are earning in terms of anything. Suppose you are, say the example of like house property. How you are going to plan? Instead of using our own funds, you buy the house through like housing loan from the recognized financial institutions. So whatever the interest you are paying up to 2 lakhs, it is exempted from your tax. Suppose if you have a 30% bracket, 2 lakhs into 30%, almost you are saving 60,000 in terms of your tax burden. So like that, so everywhere in the capital gain also, whenever you are investing something, and again you are reinvesting in some other aspect on the section 54, and there is a possibility of reducing your tax burden. So like that, if you plan in such a manner, suppose deductions under section 80, either corporate deductions and non-corporate deductions like section 80C and all those things, or 80IA and corporate deductions also there. So even in that also, you are going to plan such a manner, so you are going to reduce your tax burden. So ultimately, after calculating the taxable income, so you are going to pay the tax liability, filing of returns, and all those things that is comes under the tax management. So first thing is the tax planning. After that, it is going to be tax management. So why every person needs the tax planning? Because every person needs to reduce their tax burden. Every person is thinking to reduce their tax burden. So automatically every person needs a tax plan. Tax planning is resorted to maximize the cash inflow and minimize the cash outflow. Suppose just now I gave the example like if you buy the house through interest, so out of 2 lakhs, 60,000 you are saving in terms of the tax. So ultimately, outflow is only 1,40,000, not the 2 lakhs, because you are saving 60,000 in terms of the tax. So like that in the corporate also, there are so many things like it may be financial structure decisions instead of like equity, debt, composition, and all those things we will discuss in later stage. So in the particular situation, so if you plan such a manner, you reduce your cash outflow and increase the cash inflow. Tax is a kind of cost. The reduction of cost will increase the profitability. So tax is nothing but ultimately you are taking about the net profit after tax. Net profit after tax is nothing but cost. Tax is also part of the cost. So cost, whenever it is treating as the tax is a cost. So whenever you are reducing the tax, automatically our profit position is going to be increased. Every prudence person to maximize the return shall increase the profit by resorting to known as tax planning. Tax planning is a legal weapon to reduce the tax burden. Tax planning should be done by keeping the following points in mind. So how we are going to exercise the tax planning? Every individual or corporate or anybody, every person, they should keep some points in mind to decide about the tax planning. The planning should be done before the accrual of income. Normally, what they'll do, most of the people, they realize only in the month of March. When they calculate the income, so their income is more and their tax liability is also more. Then they think about that to invest in X, Y, Z and alternatives. But at that time, that alternative may not be available to invest, or it may be sometimes. So you don't have money to invest such a big amount to invest in the particular avenue. That is the problem may be arise in the particular situation if you realize to invest at the last moment. Any planning done after the accrual of income is known as application of income and is may lead to the conclusion that there is a profit. So that you should have the plan before accrual of income, because you must have planned aside that how much you are going to get, how much salary you are going to get, or how much income you are going to get. Already you have some plan from the last so many years you are working and you are earning the money in the particular situation. So where to invest, how to invest, you should plan the before the income arise. Tax planning should be resorted at the source of income. Whenever you are earning something, immediately you have to think about that, how to reduce the tax burden, where to invest that amount. Suppose you purchased, you sold some asset like a house. Immediately you should keep in mind, so how we are going to reduce this tax burden, how I should go to reduce the tax burden. Like that, you have to think immediately. Under section 54, there are so many options are there. In the next class, they are going to discuss. So there are so many options are there in the particular situation. So you have to think about that whenever you are earning something. So immediately you should keep in the mind that so where to invest. So suppose if you invest in some X or Y or Z, so how much your tax is going to be reduced? That is, suppose I have the money of 1 lakh. Instead of investing in the chit fund, suppose I invest in the insurance or some other thing. So I may get the exemption from the tax. So like that, there is a things in there are so many avenues are there that they have to discuss about that. Choice of an organization, taxable entity, business may be done through a proprietary company or association of persons, or it may be
Sir, unmute yourself, sir. Ah, okay, okay.
because something like whenever you are talking about that, whenever you take the organization, so there are the different forms of organizations are there, like it may be a partnership firms, or it may be AOP, association of persons, or the company, or HEO, or it may be sole trading partnership, sole trading firms are there, different firms are there in the particular thing. So which form is giving the more benefit to the in terms of the tax? So either in terms of, suppose as an individual, so instead of forming the organization as an individual, sole trader, and better to go for the proprietorship like that. So you have to think about that. Is there any possibility to start the Hindu undivided family? So like what advantages are there? Suppose there are two types of firms are there, like PFAs and PFAOP. What tax advantage there if you establish the organization as a association of persons, or it may be a partnership firm as such? So like that, whenever you are thinking about, suppose if you want to establish the company, so when you are establishing the company, where to establish, that is also part of the tax plan. Because suppose when you establish the company in Hyderabad is different from in the established company at outside the Hyderabad. Because as per the section 80 IS, there are so many deductions or maybe tax holidays are there if you establish the company in the rural areas. In the particular situation, instead of establishing the company in the near to Ayatnagar or somewhere, better to establish after like Chautapal or somewhere, you are going to get so many that's called tax benefits are there. So it is not the only criteria to establish the location and all those things, but it is also one of the factors to decide the location of the business. So like that, what type of firm to be established, and where to establish, what type of product to be produced. Suppose we say that government is going to give so many exemptions or maybe subsidies to the tax concessions to the so many types of products. If you produce X, like it may be viewers and so many exceptions are there, so what type of product to be produced? That is also you can consider there. So not only other factors, the tax is also part of that to consider that where to establish and how to establish and what product to be produced and like that. So because of that, the form of organization, or it may be the nature of the organization, nature of the product, all these are the factors of the tax planning and to decide so where to produce and how to produce. That is already discussed, like choice of location of the business undertaking also play very important role, and residential status of the person. So like suppose the person is moving one from one country to another country, suppose there are some tax benefits for the uh, non-resident Indians in the particular situation. Suppose it may be the number of days, 180 days you have to stay in the particular country. Suppose if you are coming back in 10 days less or 5 days less on that particular case, you have to make the arrangements like that. So you stay another 5-10 days and you can reduce the tax burden. So you have to see the benefit. So what is the cost if you stay outside, and what is the tax burden you are going to reduce for the particular situation? So that you have to think about that. That is the called uh, tax planning. Choice to buy or lease the asset, capital structure decision also play a major role. All these are the important areas where the tax planning can be done. Suppose make or buy decisions, whether any component or any product to by the within the organization, or it may be we or maybe you have to buy from the outside. So in the particular situation, then you have to think about that. So whether to buy the product from the same organization, or to buy the from the other organization, or make the component in the organization. Lease the assets, or it may be purchase. Suppose you take the example of machinery. So machinery to be purchased within the organization, or it may be purchased from other sources. So like that capital structure, you can take the example of capital structure. So all these things again we will going to discuss in detail about all these things, the group and data or equity and all those things. So these are the important areas where the tax planning can be implemented, and plan such a way to reduce the tax burden either individuals or it may be corporates. Yeah. Objectives of tax planning: reduction of tax liability. That we know that is the basic purpose. You are reducing our tax burden by implementing the tax planning concept. Increase the productivity. So, what is the relation between productivity and the tax planning? Productivity and tax planning is nothing but, some people are thinking that when you are, instead of paying the amount in terms of the tax, you should use that amount, whatever you are saving, that should use to get the production, or maybe reinvest in the organization, and the production should be done. Means the proper utilization of the resources. Anyhow, you are going to pay the either tax, or maybe whatever the amount you are saving from the tax, that should be going to be reinvested in the organization and increase the production activity and increase the productivity. So that is nothing but productivity. So minimal litigation. So that is nothing but, you have to observe that. So tax planning is a legal weapon of everybody. In the particular situation, you have to reduce the litigation things, because suppose sometimes in the most of the cases, if you are going illegal things, you are going that illegally, you are going to reduce the tax burden. That is a punishable thing. But in case of this thing, so you have to reduce your tax burden. You have to minimize the litigations in the thing. You have to plan such a way to reduce the tax burden. Growth with the economy. So nothing but, you say that once again there are two uh, controversies are here. When you are reducing the tax, when the government is not receiving, how it is going to help the society, and how is going to be help the economy? That is a basic question. It may raise so many economists. So yeah, how it is going to be boost the economy even you are not paying the tax. Normally, you know that as a the individuals or maybe company or the firm or anything, you are paying a tax, and the tax in terms again is coming back to the society in terms of welfare schemes, in terms of development, in terms of other ways, other manner, safety, security, everything, whatever we are paying, and it's coming back to us in terms of all these facilities. But here the growth, how it is going to be, how we are going to be linked with the tax planning and economy. Suppose say, um, uh, when I'm not paying the tax, it means, it doesn't mean that I am keeping that money in my pocket. I'm not keeping that money in my almara. What I have to do, I have to, when I want to reduce my tax burden, I have to invest that money in some way. I have to buy the insurance product. I have to invest in the fixed deposits. I have to invest in some X product, Y product, national savings certificates, Kisan Vikas Patra, or some X and X and XYZ like that. You have so many so and so options are there. So you have to invest in some way. So automatically, even I pay it may be 1 lakh tax, but to save that 1 lakh, I need to invest 10 lakhs in somewhere in the economy. So in that particular situation, in the financial market, I need to invest in terms of post office, in terms of banks, in terms of any other authorized things, national pension schemes, and all those things are there. Automatically, instead of even I'm saving it maybe 1 lakh or 50,000, but for that purpose, I'm investing the 10 lakhs in the economy. So because of that, it is going to be stabilize the economy, and stabilize the economy and boost the economy, and it also indirectly or directly helping the economy to develop. So that is this is the case. All the things, these are the objectives of the tax planning, and it is increase or reduce the tax liability and productivity and all the things. So these are the types of tax planning: long term, long range and short range tax planning, permissive tax planning, and purposive tax planning. Long range tax planning and short range tax planning is nothing but, long range is nothing but, we are going to, first thing, a plan chalked out at the beginning of income of the year to be followed around the year. So long term means you should not start your planning just end of the March or end of the February or like that. You cannot start the investment. Whenever you are earning something, whenever you are earning something, you have to invest in the such a manner, and that plan should continue throughout the year. Okay, throughout the year. So means you have to start from the April. So you know that financial year starts with the April 1st, end with the 31st March. So you have to start with April 1st. Our planning should start with the April 1st and end with the 31st March. According to that, already I told you that if you plan at the end of the year, sometimes what wherever you want to invest, that product may not be available to invest our money, or sometimes our like the money may not be available. Suppose already I told you, like if you, to save the 1 lakh, I need to invest a 10 lakh somewhere. So for that amount may not be available to invest at the only in the single month or maybe single day. So for that purpose, you have to plan for the long term. Short term is nothing but mostly most of the people what we do in that particular case, only all the investments, all the things will be recollect only at the time of the filing the return or just before the end of the March. So this is called short term tax planning. It is also legal manner, but it is not the correct the tax planning which you are realized only at the end of the financial year. There are some problems are there to invest in those cases. Better to go for the long term tax planning, and that should be the institutional tax planning is always the best. Means so every time you try to whenever you get the income, always you think about the alternative investment. Permissive tax planning. So means the tax planning is nothing but our investment to be made within the boundaries, making plans which are permissible under different yeah. Permissive tax planning, making plans which are permissible under different provisions of the law, such as planning of earning income covered under Section 10, especially the Section 10(1) planning of taking advantage of different incentives and deductions, planning for availing different tax concessions. So there is a list of tax exemptions are there under Section 10. So the next class we have the list of exemptions under Section 80 and 10. So that is nothing but within the permission limit. So you try to invest our amount. So that is nothing but permissive tax planning. Yeah, purposive tax planning. Making plans with specific purpose to ensure the availability of maximum benefits to the SSC through the correct selection of investment, making suitable program for replacement of assets, varying the residential status and diversity in business activities and income, etc. So this is the most important tax planning, purposive tax planning. Normally, what you have done at the time of end of the March, whatever the products are available, just like that we buy the products and we try to reduce our tax burden. But that is not the way to that. Purposive tax planning means you should commit that where to invest, even in the company. So which machinery to buy. So that machinery whether to buy or take the lease. That is nothing but purposive means when what we want in the particular area, you try to reduce your tax burden, but not for the tax you cannot plan anything. You have to plan, and within that plan you have try to take the tax into consideration and take the decisions, but not for the tax purpose. You cannot plan that, because I am also ready to reduce my tax burden to zero, but for that purpose I cannot sacrifice my own interest, I cannot sacrifice my own family, I cannot sacrifice the other things. So because of that, what I'm means to tell, so that so whatever you purpose is going to be survived, like what is our aim. Suppose you want to buy the house, in that house how you are going to reduce your tax burden, you have to think about that, but not that you have the money and you have to reduce the tax burden. For that purpose you cannot buy the house. That you have to think about that purposive, that is called as a purposive tax planning. Everybody should be in the purposive tax planning. Now coming to two important areas, like tax avoidance and tax evasion. One is the legal purview, another is other than the legal purview, that is called illegal. tax avoidance is an art of dodging the tax without actually breaking the law. It is a method of reducing tax incidence by availing of certain loopholes in the law. The expression tax avoidance will be used to describe every attempt by legal means to prevent or reduce tax penalty which would otherwise be incurred by taking advantage of some provision or lack of provision in the law. So yeah, all we experienced that. Just I will give the live example. Suppose you go to the traffic signal. Suppose if you jump the signal, that is called tax evasion. That should be punishable. You get a chalana, so that is called tax evasion. Tax avoidance within loopholes in the sense some people observe that instead of jumping the signal, they take the left. Again, there is some divider cutting, and from that again they join to the main road. That is nothing but tax evidence. Means actually that is not punishable. They are trying to find out the loopholes in the system, and on the base of that, they are trying to find out some shortcuts, and they are trying to achieve the target. Same thing in the tax also. Within the loopholes are due to lack of some provisions in the act, whatever the acts are there. From that, they're trying to take into consideration, and you have to think about that, so they reduce their tax burden within the law. Within the law. So it is a method of reducing the tax incidence within the loopholes of the, or loopholes in the sense it is not illegal loopholes. So, but whatever the provisions are there, from the provisions we are taking into consideration, and again you are trying to some thing like some meaning things they are going to find out, and they are trying to reduce the tax burden. That is not that is called as a tax evidence. It is a legally valid tax planning. Tax evidence is a legally valid thing. It excludes fraud, concealment of other illegal measures. It is a device which technically satisfies the requirement of the law, but in fact is not in accordance with the legislative. So, like it is actually it is not fraud, and it are going to be technically satisfy the things. Causes why the tax evidence. Not agree with the issue of generating black money by avoiding of tax. In legal tax evidence, the money neither goes out of the book nor it is spent unnecessarily, but is used for the further expansion of the business. So why they are allowing the tax evidence by reducing the tax burden and all those things? This is not going to be create the black money, because they have to show the total income in the books of accounts. Suppose you take the example of company, they have to show the all the amount, whatever the amount they earn, they have to show in the books of accounts, and whatever the expenses are there, that also they are going to be shown in the books of accounts. But only thing is, so whenever they are going to be any the provision is there, that legally they are utilizing that provision, and they are reducing the tax burden, that, but so tax evidence. So like because of that, so just you see this diagram, there are more than 400 crores of like tax cost of tax evidence. Means how the people are reducing the tax thing, how many people how many crores every year. So that is the government is going to lose by the different countries. So United States, it is around 400 crores. China, it is 66.8 crores. Japan 46.8 crores. India around 41. France around 20 crores. Germany around 15 crores. Australia around 6 crores. Spain around 5 crores. South Korea around 1, and United Kingdom. These are the billion. Sorry, that is called dollars in billions. So these are the amount because of the tax avoidance. Even it is a legal thing, but they are not in a position to pay to the government because of their availing the legally they are availing the, that's called tax reduction. This is called billion in US dollars. So this is the amount governments are losing from the tax. Coming to illegal things, if you go for the tax evasion, when you're not use the legal framework, beyond the framework, we are going to reduce our tax burden. That is the punishable thing that is comes from the tax evasion. when a person reduces his total income by making false claims or by withholding the information regarding his real income so that his tax liability is reduced is known as tax evasion. So tax evasion in the sense it is an illegal thing. Suppose say they are not revealing the total income in the returns whenever they are submitting the returns, so they are not showing the full income, and sometimes they are showing more income. Okay, sometimes you know that as per the income tax act, companies should not pay the total amount in terms of the cash. So only suppose if they pay more than like 20,000 rupees in terms of cash, so that is not that is allowed as inadmissible expenses. It is not allowed as a admissible expenses in the particular situation. So generally, what they think about that is called tax evasion. Means even they're recreating their own bills and recording the transactions, and they're not paying in terms of like checks and all those things. In the particular situation, there that is comes under the tax evasion. Sometimes zero market, they are not showing their total income. Sometimes if you go to the shop, they'll ask that if you want bill or not. If you don't pay, if you not don't need a bill, they reduce your that's called total price. So like that, they are earning. Even if they reduce for you, it may be 5 rupees. They are evading the tax by it may be 10 rupees or 15 rupees for each bill. So like that, whenever you are tax evasion in the sense illegally they are doing the things and they are reducing the tax burden, that is nothing but tax evasion. Tax evasion is not only illegal, but it's also immoral, anti-social, and anti-national practice. Yeah, I already showed the image that is a punishable thing, and if you go for tax evasion, it is not allowed as per the Income Tax Act. Therefore, direct tax laws provisions have been made for imposition of heavy penalty, institution of prosecution proceeding against the tax evasion. Suppose if you go for the tax evasion, so normally we are going to go punishable as per the act. So now it is a tax evidence is legally applicable, available, and tax evasion is not available legally. Just I will show the one example like, so this word is called as a God is nowhere. When you go to immediately, you go for God is now here. What is the difference between these two words? Only the space. Space before W and after W. It makes the totally entire meaning. So God is nowhere. You means that God is not at all there. So God is now here. The God is already there. In the particular situation, sometimes what it means, uh, you have to understand. You have to understand the concept broadly. Sometimes just because of the like a typographical mistake or maybe sometimes your the phrases maybe give the different meaning, but when you study the total act that convey the different meanings. In the particular situation, you have to think about that. So the what is the intention of the constitutional framework, that is the final, and according to that you have to plan our tax system. The not according to the word to word, that is not the actually the meaning which convey to understand the what actually tax it is, what exactly what is the tax coming it is. So that is nothing but you have to understand that what is the so it is just because of the space between the W in before and after. So it totally giving the total opposite meaning. So you have to understand the intention. You have to understand the meaning of the total the act in terms of the total tax act to be understand, but not the that is called individual words, individual letters. It cannot convey the exact meaning and exact understanding. So according to that, you cannot avoid the tax just because of space, just because of spelling mistake, just because of other things. So you have to try to understand the total intention of the concept, intention of the act to be understand, and according to that, you have to convey the meaning. So tax evasion is a possible just because of all these factors. Sometimes, most of the cases, whenever you have the more the tax bracket, higher tax bracket, normally you try to reduce tax burden. Suppose I'm ready to take maybe 10%, but when I'm coming to 30%, I have to think, if I earn 100 rupees, I have to pay 30 rupees to the government in terms of tax. Then I have to think more about that, how to reduce my tax burden. So that's what the most of the cases. So they're trying to reduce their tax burden, either it is legally or illegally, and comes under tax avoidance or tax evasion. In the particular situation, social psychological factors, complexities of the tax system, so mismanagement, unequal distribution of amenities, nature of economy, agriculture, all these factors are so many factors are there for the tax evasion that it creates the black money. So that is called, earlier I gave the example two things, it may be tax avoidance and tax evasion. Tax avoidance may not lead to the black money, but tax evasion is going to lead to the creates the black money because tax avoidance within the legal framework, and they have to plan such a way in the to reduce the tax burden and from the provisions of the act only. So, but they are not showing any less income or more expenditure. But tax evasion is a possibility of showing the less income what actually they are earning and showing more expenditure not actually their incurred and maybe spent in the organization. This is the amount where actually our countries are losing through the tax evasion thing. Either the US $1 billion. US itself is losing, as per the estimation, 337 the $1 billion are losing just because of tax evasion. The Brazil is also 280 crores. Italy, there are 238 crores. Russia, around 221 crores. Germany, around 215 crores. France, 171 crores. Japan 171 crores, China 134 crores, UK 109 sorry, billions, and Spain 107 billions billions. So these are the countries. Already I showed you how much amount they are losing just because of tax avoidance earlier, and now this diagram is showing how much amount is they are losing by the countries, different various countries, because of this tax evasion. This is the basic difference between that's called tax planning and tax evasion. This is the within the corners of the tax system, tax laws. That is nothing but tax planning. It is beyond the act. It is nothing but tax evasion. One is a legal thing, another is totally uh, illegal things. And one is generate the black money, and another is not generating any black money, and also it is helping the people to reduce their tax burden. One thing is when it is a tax, you should make the tax planning properly, so you don't have any problem. And companies or individuals no need to go for the increase their BP for the rights or maybe seizures of assets, seizing of assets, and all those things. It may not be there, but when you go for the tax evasion, so maybe may not be today, it may be tomorrow or after some time. Definitely, they're going to be catch you, and you have to pay the total amount with interest. Recently, the government also is introduced so many schemes to attract the this called tax in terms of the reduce the black money and all those things. Coming to the next important point after the tax planning, they're coming to the tax management. So tax planning is nothing but that is a part of reducing the tax burden. Tax management is not for the reducing the tax planning, but systematic implementation of the things from the beginning to end. That is nothing but tax management. Tax management refers to the compliance with the statutory provisions of the law. It includes the maintenance of accounts, filing of returns, payment of taxes, deduction of tax at source, timely payment of advance tax. All these things comes under the tax management. Means, suppose if you are the good citizen, you know that you are paying tax. Your employer is reducing the tax from our salary, and companies are reducing the tax whenever they pay the amount to the shareholders and all those things, the dividend tax and all those things. But that may not enough to free from your responsibilities. Suppose I, as an employee, and my employer is reducing my tax from my salary, but that is the only thing I may not free from that, because again there are so many responsibilities are held with me, even I'm studying tax or not. But every SSC has so many responsibilities to fulfill for regarding to the tax is concerned. That is nothing but you have to file your return, you have to submit your accounts as a company, or suppose it is a firm, or it may be HF and some other than individuals. You need to submit, you have to close the accounts at the end of the 31st March, and you have to submit, and you have to audit it. Suppose it is compulsory audit projects are there for some companies uh, in the particular situation. So your responsibility held with to see that your accounts to be audited, and you have to submit your returns, you have to pay your tax. Is there any the tax is due? You have to pay the tax, and your response as a company, your responsibility is to reduce the tax from the like source. Whenever you are paying the salaries to your employees, or when you are distributing your dividend to the shareholders, or you are paying any rent to any the landlord, or it may be the owner to any company or house, or maybe missionary or something. And in those cases, that is your responsibility as as a company, the director, managing director, that is their responsibility to reduce their tax from their source. Timely payment of advance tax, and not only the to reduce the tax, and as a taxpayer you have to reduce the advance tax, you have to reduce the tax, you have to pay the tax in advance. So if before that, the 15th March, in the four installments, you need to pay your total tax. So then only you can avoid our interest penalty and all those things. Otherwise, you are paid. Yesterday, I think already you listened from the Patrick sir regarding to that, when you have to pay the advance tax, how to pay the advance tax and tax deduction at source and all things. Again, no need to say. So in the particular situation, that is nothing but tax management. So when you're talking about the tax planning is always you're looking for the reduce the tax, and the tax management is implementation part. Already I showed this called the pro forma for like computation of income. The first part up to the deductions, that is comes under the like tax planning. But after that, when you find the tax liability, from that it starts the tax management. You have to fill your own returns. Tax planning is optional, but tax management is mandatory. It is true, because if you want to reduce your tax burden or not, that is up to you. If you are not interested, you are ready to pay the more tax, so nobody will bother about that. Everybody is happy, and the government is also happy to take that more tax from you. So that is optional. But when you come to tax management, it is a mandate. So that, because already I told that as a like the individual or company or firm or HO, that is your responsibility to fulfill the above. Already we discussed, like the maintenance of the books, filing of the returns, like the payment of taxes, TDS, advance tax, and all those things. These are called mandatory things. So by end of the year, or it may be according to the times dates which are given, so according to that, definitely you have to fulfill those conditions. That is nothing but tax management. That's why tax planning is optional, but tax management is a mandatory. Poor tax management may lead to the levy of interest, penalty, prosecution, because when you are not submitting your return, again there is a penalty. When you are not paying the advance tax, again there is a interest. When you are not reducing the TDS from your employees, again there is a interest to be paid by the organization to the income tax department. So for that purpose, when you are not planning such a manner, so in that case you are held responsible to pay the penalty or interest and other things, whatever they levied by the like income tax department. And management relates to management of finance, payment of tax, advance tax, and all these things. Already we discussed about that. And every person, or maybe That is, you have to ensure that you are paying the tax is one angle. Another angle is whether you are paying the tax in time, within the time limit you are paying the tax or not. That is the two things you have to ensure and make sure that you are paying within the time. Otherwise, also even you are paying exactly, you are paying whatever the tax is due, but you are paying after 1 year or 2 years, nobody will accept it. That is comes under the, that is called that is punishable and that is not acceptable. Again, that is again you have to go for the so many formalities. According to that, you have to go for that. These are the important areas of tax management and generally where you are using the tax management. Deduction of tax at source under section 194 to 196, that is comes under the forms. Payment of tax and self-assessment under section 140. Payment of tax on demand, section 220. Maintenance of effect, accounts under section 44. Audit of accounts, 44 AB. Payment of sales, duty, fees, bonus, commission to employees. Furnishing written of income. Documentation and maintenance of tax files. Review order received from tax authorities. All these things are the part of the tax management. Tax planning is for the normally to spend the amount, where to invest, how to invest. So where should we establish the organization, what type of product we produce. All this comes under the tax planning. But to implementation part to all is the maintenance of accounts and some the provisions, whatever the income tax provisions are there. So for that purpose, so all these things you have to think about the tax management, because you should be careful about the tax management and than the tax planning, because tax planning already we discussed about that. Tax planning is optional. Suppose if you are paying more tax, nobody will bother, but when you are not submitting your return, automatically you will get the notice from the income tax department. Tax management, that is called, all these things already we discussed about the consequences, department orders to be considered. So these are the basic differences between the tax planning and tax management. Tax planning is to minimize the tax liability. Tax management to comply with the provisions of income tax law and its allied rules. Planning is to reduce, management to manage the over as per the provisions of the income tax law. Tax planning also includes tax management. Tax management deals with the filing of return in time, getting the accounts audited, and other sources. So it is the tax planning relates to future, and tax management relates to past, present, and future. So past is related to assessment proceedings, appeals. Present is related to filing of the returns, and future is related to take corrective actions if anything has happened or we received any orders from the income tax department. So these are the essential differences. This is optional, and this is thing. These are the basic differences between the tax planning and tax management. Now this is the overall the structure of what the basic inputs of like what is meant by tax planning and what is tax management, what is the tax evidence and what is tax evasion. So ultimate the basic conclusion is so every SSC, either it's the corporate SSC or individual SSC, you need to follow the two things to be assessed, because I already know that the 5 heads of income and the computation of income, directions and everything, you know that nobody knows as the commerce teachers and students, you know that. But at the same time, you have to think about the what how to reduce some tax burden, how to submit your returns without any complicated things. So that is the what is the tax evidence within the legal framework, how to reduce the tax burden. So what is the legal thing, what is punishable? Everybody should know about that. So that is comes under this tax planning. What we discussed till now. Coming to the corporate tax planning, there are two different tax plannings. One is the individual tax planning. As the individual tax planning, I think you have the next session like investment revenues, tax considerations. So now I will focus on only the corporate tax planning. What is meant by corporate tax planning? What decisions comes under the tax planning with the companies, that is going to be discussed. Basically, there are three areas of the tax planning in corporate tax planning is concerned. The one is capital structure, another is management decisions, and third one is the nature and location of the business. So in the capital structure, normally whenever you need some money, even as an individual, as a company director or managing director, whenever you need a money, there are so many alternatives are available. Like it may be take from your like bank, or take from equity, take from your friends, or take from some other alternatives are available. So many alternatives are available in the particular situation. So which option to be considered in the which situation? That is nothing but the capital structure decisions regarding to the tax planning. So in the particular situation, according to the need, availability, and terms and conditions, and you can decide that what type of fund to be utilized for the organization. At the same time, you should consider the like tax benefits also to be considered before taking the decisions, because either as an individual, your tax benefit maybe 5,000 10,000 if you plan for the tax planning and all those things. But when you come to the organization, and come to the corporates, so normally when you plan such a manner, so you can save the some lakhs of rupees or crores of rupees sometimes. So for that purpose, tax is also one of the important factors to take the capital structure decisions in the corporate world. These are the some important aspects regarding to the capital structure. What factors to be considered? Interest on debt fund is allowed as a deduction as a business expenditure. It may increase the rate of return on owner's equity. Dividend on equity is not allowed as a deduction in the appropriate of profit. Dividend is exempt in the hands of the shareholders. Company declaring the dividend shall pay dividend distribution tax 15% and other tax. Like that. So it means interest on debt is allowed as a business expenditure. Suppose if you take 1 crore debt, out of that you are paying 10% thing. So 1 crore into 10%, it may be 10 lakhs. You can claim as a expenditure from in the books of accounts. In the books of accounts, you can claim 10 lakhs. That is not the small amount, because in the corporate tax, it may be 25%. You can save like maybe 2,50,000 rupees as a tax. So like that, dividend in the equity is not allowed as a deduction. Okay, dividend is not allowed as deduction. So because of that, you have to think about that. So either go for the debt fund or you go for the equity, issuing of equity, and get the tax benefit. In addition to these two things, cost of rising owner's fund is treated as a capital expenditure. It is not allowed as a it is not allowed as a deduction. So section 35D is satisfied and specified expenditure can be amortized, like a preliminary expenses. So cost of rising owner's fund. When you are issuing equity share capital, any incidental expenditure is incurred in the particular situation, so it is allowed as a capital expenditure. It is not allowed as a revenue expenditure. When it is not a recurring expenditure or revenue expenditure, normally it is not going to be allowed as a business expenditure. So in the particular case, they cannot claim as expense, and they have to pay the tax on that. Cost of rising debt fund is treated as a revenue expenditure. So not only the interest which is to be paid on the your debts, and in addition to that, the cost of rising the debt. What are the expenses which are incurred to rise the like loans, bank loans, or maybe other type of loans in the particular situation. So there's debentures and all these things. So that is allowed as a business expenditure, but not the cost of rising the bonus fund like equity fund. It is not allowed. So tax planning. What is tax planning here? The return on investment is more than rate of interest. Maximum debt funds may be used. Shall increase the rate of return on equity. However, cost of rising debt funds should be kept in mind. So in the what we have to do that, you know that as a income tax students, we know that. So interest is allowed, but dividend is not allowed as a business expenditure. But in that case, in our tax planning, when the return, our return is more than the what you are paying to the creditors in the particular thing, you can use the more thing. Suppose you are getting the return of 20%, you are paying only 10% interest in the particular thing. So instead of equity, you go for the more of loans and other things. That is nothing. That is our tax planning. If the oppositely, the rate of return investment is less than the rate of interest, we go for the more of equity than the loss. So minimize the debt and maximize the things. So in addition to our basic things like debt equity mix, debt equity ratio and all those things. So when you consider the tax is a factor to decide the capital structure, so when you have the more return than what we are paying to the debenture holders or maybe paying to the loan people, lenders, in the particular situation, better to go for the return on that's called it, tax planning, and more debt is required. You can invest, you can get the loans from the others and instead of go for the equity. Whereas the one more important thing is sometimes there are some tax holidays are there for the some organizations. In the particular situation, normally, suppose already I give the example like under section 80s, 80IA, 80IB, 80IC, like that, so many sections are there. In the particular situation, if companies, some companies are established in the rural areas, some companies are established in some important areas like backward states or backward districts, and those cases, so there is no tax at all. Even there, even you're getting more of tax in the particular situation, so you can go for the equity, because even you have the it may be 1 lakh or 1 crore or 10 crores income, sometimes there is a 100% tax holiday, no need to pay any tax up to certain period, either 5 years or 10 years, according to the that is called the nature of the organization and the nature of the like location of the business. So it is extended, it may 5 years or 10 years or 15 years are there. So according to that, some cases even you earn more, so no need to pay any tax. In those cases, better to reduce the interest and better to go for the equity. Even we have more than, so no need to go for any tax. This is regarding to the capital structure decisions. So how we are going to decide our capital and how much capital we are going to take and how much like loans or maybe other borrowings we are going to consider for the buying or anything. So coming to the tax planning with make or buy decisions, when you compare the whether to reduce whether to produce the particular component or anything within the organization or buy from the market, here you have to think into two parts. Cost accounting decision is different from the called tax planning decision is different. When you're talking about the cost accounting, you take only two factors, the making cost and buying cost. When the making cost is more than buying cost, you buy the product from the market. If the buying cost is more than the making cost, better to manufacture the product within the market. So that's what we learned in the cost accounting. But when you come to the tax planning, when you come to the taxation, other factors also to be considered, whether you go for outsourcing or in-house. So you have to so many factors to be considered. So it requires the product and any other non-costing considerations and other thing costing and non-costing consideration, including the tax. So these are the important factors to be considered here. So infrastructure facilities, this is a normal thing. What in addition to the taxation, so there are so many other factors that should be considered for that. Again, tax, just I'm not going to that other factors because already we know that. So tax related considerations. Tax related considerations are nothing but surplus capacity. Even decide to buy the product, it may require to sell a part of its plant and machinery. In such a case, it may be liable to capital gain tax. Suppose already you have the equipment, already you have the infrastructure, but you are interested to buy the component just because of the that is called buying cost is less and manufacturing cost is more. Suppose if you are trying to, as per the cost accounting decision, you are buying the component from the market, uh, but whatever the existing machinery is there in the organization, when you are selling that machinery and you have to attract the capital gain tax. So you have to pay the 20% capital gain tax if you are selling that one. So in that particular situation, you have to think about the tax is also part of that, and again you have to compare the capital gain tax and that's called whatever the amount you are saving between the manufacturing cost and the buying cost, buying price. So in between that, how much you are saving, how much you are paying in terms of the capital gain tax, and compare these both the cash inflow and cash outflow, and then you have to take the decision that how much you are saving in terms of that. The new industrial undertaking is established make the product which fulfill the conditions section 80A, IA, 80IB, 80IC. Direction will be allowed to compute the income tax liability of the undertaking. So one more important thing is regarding to make or buy decision. Suppose if you buy the component from the market, only the buying cost will be exempted from the tax and that will be shown as the expenditure. But when you come to when you establish the new unit and if it is a new business and located in the specified areas, if you establish the particular business in the specified areas and they can, if they comes under the section 80 IA, 80 IB, 80 IC, like it may be new industrial undertakings and like some specified economic zones, special economic zones, or maybe some backward states like that. When your option to establish the such type of organizations in the such type of locations, so we are going to lose that particular tax exemption because when there is a tax holiday for under these sections for these type of companies, so no need to pay any tax. In the particular situation, suppose instead of producing on our own, you are buying the component from outside and we are going to lose such type of income. So you are losing that tax burden also, the tax amount. So that is the case. You have to think about that. This is a tax related concern. And again, it is a any depreciation, whatever. Suppose you are want to produce the product in an organization, when you are talking about buying the machinery or any other asset, so you can allow the depreciation. But when you buy the component from the market, so that is not allowed. Depreciation is not going to be claimed. So like that, all these factors are like you, whenever you are talking about the make or buy decisions, you have to think about that. So this is the case. You have to think about the thing whether you are going to produce the component or you buy the component from the market. The tax implications also there, tax considerations also there, and according to that, you have to make the plan. If it is a like quantifiable amount or significant amount of the tax when you are saving, so better to go for according to that you have to take the decisions. Yeah. Next, you go for the own or lease the product. Own or lease the product. Sometimes, if you want a machinery to produce the particular product within the organization, in the particular situation, shall we shall we buy the product for the organization? Earlier we discussed about the make or buy decision. You're talking about mostly like the component, one particular component, whether to produce with the organization or not. But when it comes to this one, suppose if you need a machinery, suppose you need a vehicle, transport vehicle for the organization, shall we buy the vehicle for the organization or get it on lease and use for the organization? That is the case. You have to consider the tax considerations when you're talking about this own or lease. A lease of property is a transfer of right to enjoy such property. Already know that definition, what is meant by lease or own. So when you're talking about the lease means transfer of property. Only the using rights will be transferred from lessor to the lessee, and lessee, as per their agreement, particular certain period, they can enjoy the use of the particular product. And consideration price payable periodically to the transferor by the transfer. So in that particular case, so for that consideration will be there, the amount they have to pay for the in case of lease in terms of what's called as a lease rent, and lease rent is paid to the lessor when you are the lessee using the particular asset. Leasing is an arrangement that provides a person with a use and control over an asset for a price payable periodically without having a title of ownership. So you are not transferring the ownership title to the lessee, but they are enjoying the lessee is enjoying the like total the product is going to be used. Lease agreement of the owner of the asset is called lessor, and the other person is called a lessee. So these are some important factors like cash position, depreciation, obsolescence risk, residual value, profit margin, profit after tax. All these things that is called normal things where generally as the cost accountant or is the management accountant normally think about that whether go for the own or lease. Now you have to think about the tax consideration. If you buy the like machinery and the particular asset on our own, what benefits are going to enjoy? Suppose if you are not buying and you are going for lease, what benefits are going to be enjoyed? Can claim the depreciation at prescribed rate. Suppose if you are buying the asset, you can claim. Same time here you have to think about one more thing. Suppose if you buy the asset, the particular machinery or particular asset on through the borrowing funds, whatever the interest you are paying to them, that is also allowed in the business expenditure. Not only the depreciation, in addition to depreciation, whatever the interest you are paying to the lender, so that also it is can claim. Any other expenses, repairs and maintenance of the assets, then that also can claim. Suppose your own asset, if you are using for the purpose and if you spend any amount for that, that is also can be claimed. That is already discussed expenses. So if you buy the asset, there are three things can be claimed. One is the depreciation, another is the repairs, another is like interest. For lessee can claim only that is called lease letters. So whatever the lease rental is paid by the lessee, that is can claim as a business expenditure. Repairs and replacements. So that is what is the tax consideration repairs and replacements. Suppose we can say that if it is a renewal or replacement, if it is treated as a capital expenditure, they can claim the depreciation. Okay. Generally, the difference between the repairs and replacement is repairs normally it comes under the recurring expenditure. The replacement comes under the capital expenditure. Once it is treated as a capital expenditure, so normally they cannot claim as a uh, expenditure. So in the particular situation, you have to think about that. Whether it is going for the replacement or renewal, that is also part of the tax consideration. Next one is the shutdown or continue. The whether when you are incurring the continuous losses, so how it is going to be like you have to think about that. Whether you are going to discuss, whether you are going to continue the organization or you are going to close the organization and all those things. Again, there are some tax implications are there in the particular thing. So whether you are going to think about the tax plannings are there, that is called treatment of losses and unabsorbed depreciation, business loss and unabsorbed depreciation. So what is the tax consideration in terms of regarding to the shutdown or continued decisions? So treatment of losses and unabsorbed depreciation. When the business is old as a discontinued or closed down, the brought forward business losses and unabsorbed depreciation shall be dealt with business loss unabsorbed depreciation. Suppose sometimes business loss, if you close the organization, so generally you cannot the like the set off of those losses if you shut down the organizations. Means when you are getting the losses, when you shut down the organization, that will be carry forward for the future. That cannot be carried forward for the future to set off for the future losses or profits. But unabsorbed depreciation, it can be carried forward even your closing the organization, that can be set off carry forward, that can be carried forward for the future purpose. So that is the case. That is the tax planning regarding to the shutdown or continue. So this is regarding this my presentation regarding to the tax planning, and the time is also about to close. And this thing is here there is just I'm giving the scope for the uh, some research areas also there regarding to this tax planning, because what we observed that nobody is doing the research in terms of in the area of tax. Everybody is doing accounting or maybe insurance or finance and all those things. Very few, maybe one or two people, I don't think. So they're doing the tax research, but nobody is doing research because it's a the big scope for the tax research in the tax areas. Like that, you have to think about that. Wherever, suppose you take the example of tax planning, you can take the few people from the different areas, like take the opinions of the different respondents and how they are making the tax planning and how they are getting the benefit through this tax planning and all those things. That can take the beneficiaries of through the tax planning. You can make the study of that. Okay, like individuals or it may be corporates. There is a two different researches. One is for individuals and another is for the corporates. So every area there is a scope for the research. They have the people are just so many students are here and faculty is also there. So just what I am trying to tell that instead of going the regular like it may be finance and all those things, insurance and all those things and duplication of the work. So instead of that, if you do the research in the tax, either in terms of tax planning or tax management or corporate tax planning, like in the different areas can be discussed in that. So in the particular situation, if you do the research, so normally you don't have any plagiarism also because you become the first one or two candidates. So normally you can do your own genuine research. So normally it may not be happen. So in that particular case, I'm requesting all the people think about that's called research in the area of these areas. Okay, this is my the presentation. So once again, I thank you all the participants and other listeners for patiently listening for this session on the tax planning. So next the session is about to start immediately is going to be start. Already sorry, I already admitted I think. So it is going to be started. Thank you once again. Thank you to all participation for my session and also for the total the program of workshop. I'm very much thankful as a director. I'm also thankful to all the participants. Thank you once again. Just I'm closing my. Yes. Yeah, Ramesh sir, is it audible? Ramesh.
So thank you very much, sir.
Hello.
Thank you very much, sir. You have thrown light on various issues like what is the concept of tax planning, objectives of tax planning, and why every person needs a tax planning, the impact of choice and location of organization on tax planning, residential status of tax on tax planning, what are the decisions regarding buying or leasing or capital structure, make or buy decisions on the tax planning, and you have thrown light on tax avoidance, tax evasion, and tax management, and the differences between tax planning and tax evasion have been made clear by you, and you have thrown light also on corporate tax planning and tax related considerations, repair, replace, shut down, continue decisions in tax planning, and not only that, various research areas that are available for research in tax planning. All these topics are dealt clearly by you, sir. So thank you very much, sir.
Yeah. Thank you, Ramesh. Thank you.
Thank you. So now our
Now
first person of the day is present. I am very, very happy to introduce Sri Prithvi Burgula Garu. Prithvi Burgula pursued his BTech Mechanical Engineering from Kakatiya University, Kakatiya Institute of Technology Science, Warangal. He was the recipient of the Best All-Rounder Gold Medal instituted by State Bank of India for the batch of 2012. And he worked briefly for Accenture before pursuing a master's program, MBA, International Business from Symbiosis, Pune. He has participated in Model United Nations and Model World Trade Organization summits held in various colleges and has been awarded the Best Delegate Award in Model United Nations in 2014 and Best Speaker Award in WTO in 2015. And he worked as a fixed income dealer in Darasha and Company Private Limited, which is an investment banking company after his MBA, and is now associated with HDFC Asset Management Company Limited as Manager Corporate Sales in Mumbai head office. And he handles relationships with banks, insurance companies, and pensions funds in the current assignments. He loves reading about markets, economies, and playing table tennis. He has represented Kakatiya University in All India South Zone Inter-University Table Tennis tournaments. And he will deal with investment avenues, tax considerations. Up to Prithvi Burgula garu. Sir, please take over, sir.
Thank you so much, Ramesh sir, for the kind introduction. My regards to Ravi Kumar sir for and also Osmania University Department of Commerce for organizing this session. Is it audible?
Yes, sir. Yes, sir.
Yes.
Yeah. So I thought I'll just share my screen before.
Yeah.
Sir, you can kind of stop sharing my screen, sir.
One second. Co-host, I'm doing the co-host debate.
Please, sir. Yes, sir.
Yeah, you can check.
Just a minute, sir.
You can check.
Prithvi garu, sorry, sir. Without your permission, I have downloaded your photo from internet.
Absolutely fine, sir. It's all right. So, in fact, it's in the public domain. Just a moment. Is my presentation visible to everyone?
Yes.
Okay. So thanks again, sir, for the introduction, and also my best regards to Osmania University and for organizing this financial literacy program. I am really happy to be a part of this session on taxation, and I'll be dealing with the various investment avenues and the tax considerations available for investors at large. This session is basically to help you understand on various avenues where you can save tax. Basically, we need to understand what tax is. Firstly, tax is a charge which is usually of money imposed by authorities. Authority could be a government or a local municipality or any authority which has a power on persons or properties for public purposes. So, what is public purposes and where do you use it? That I'll come to it at a later stage. But I'd like to quote Albert Einstein, who said the hardest thing in the world to understand is income tax. So, a person like Albert Einstein also failed to understand income tax. And someone also quoted that people who complain about taxes can be divided into two classes. There are two types of people who basically complain about taxes. They are men and women. So basically it's everyone. Right, friends? So you have people complaining about taxes when they pay tax. They, people do not understand income tax. People do not understand taxation and various other implications. And then sessions like these will really help you from, there's a little takeaway, at least I'm sure, from sessions like these, where you can save tax and also use it for better purposes. So why basically is tax collected in a country like India? So the end use of this tax money, which is being collected, is being spent on infrastructure, it's on healthcare, it's on financial inclusion, education, research and development, defense spending, insurance protection, and food security. So these are the broad headings. I must have missed out a few, but yes, broadly, these are where your tax money is being utilized. I'm not only talking about your income tax, but also the GST and other taxes which are collected by the government. Infrastructure is one prime spending of the government, and the government, of course, needs tax money to spend more money on that. When I mean to say food security, I mean to say that the governments in general, the state governments or to a certain extent central government on certain crops decides the minimum support price on certain food items. So that is basically to ensure food security, and that is subsidized by your own tax money, the tax money that you are paying to the government. Of course, it's very important to spend some money on research and development. A lot of money is being spent by various countries across the world, and that's tax money, of course, on finding the new COVID vaccine. COVID has, thrown us out of care. It came as an unprecedented event. No one had anticipated such kind of an event. A prolonged lockdown, and economic activity has taken a hit. Same is the case with our tax, collection. The governments have faced huge tax crunch. That is, they have not collected adequate taxes or the anticipated taxes that they were expecting in a complete year. What is the government's endeavor when they actually collect taxes? This this line I've picked it up from the budget speech 2020 by our Honorable Finance Minister Srimati Nirmala Sitharaman. She said that the government's endeavor is Sabka Saath, Sabka Vikas, and Sabka Vishwas. So if I'm a taxpayer or you're a taxpayer, I understand that you're not very happy that you're paying taxes, but ultimately it's for Sabka Saath. We need to take everyone together. We need to also think about Sabka Vikas. We also need to keep in mind that there are people or the underprivileged segment where we need to help them out with the tax-paying money that we have, and also gain trust. We need to have Sabka Vishwas. Also, I'd like to point out something about tax spends on education. Dear friends, there are so many public-funded universities, including university like Usmania University, where education is subsidized in a very big way. So again, where does that subsidy come from? Where is that the education is being funded? It is because of taxpayers' money. So that's what I would want to talk to you about, the end use of taxes. So let me not spend much time on this, and I'll continue my session on various ways that you can save tax by investments. So in the previous session, I just heard that you had dealt with the concept of tax avoidance. Tax avoidance as such, if you see, it is not, when you hear the term tax avoidance, it might not be a positive term, but legal tax avoidance, yes, is the leeway is available through tax savings. So the Income Tax Act 1961 allows income tax deductions or exemptions under various sections in the Act. The most popular being 80C, which is investments in various tax saving options. I'll talk to you about various 80C options at length. Then you have 80CCC, which is investments in a pension, or buying an annuity plan from an insurance company. It could be 80CCD, which is opting for National Pension System, NPS. I'll talk to you about it at a later stage. 80CCG, which is Rajiv Gandhi Equity Savings Scheme. This, I just put it up in the slide because it is still available in the Income Tax Act. However, this has been phased out. So there is no longer 80CCG. Rajiv Gandhi Equity Savings Scheme would no longer be there. It is being phased out in a phased out manner. Then you have 80D. You can get an exemption for buying a health insurance policy for yourself and your family and your dependent parents, if any. 80E, that is interest paid on education loans. You would be, there are certain people who take education loans, and then the interest component of it can be deducted from their income to when they compute tax. So that is 80E. 80EE, home loan, something like a first purchase or a first homeowner. It's kind of an investment as well. So even when you invest in a property or in a housing asset, you get exemptions under 80EE for the interest that you pay on your housing loan. 80G is, of course, donations towards social causes. You can get exemptions on the donations that you make towards various social causes. It could be a charitable organization. It could be any of the other trusts which have the 80G eligibility. So let me talk to you briefly about the various investment avenues. So I talked to you about the various sections which offer tax benefit. Now I'm going to talk about the various instruments or various avenues which are available for an individual or sometimes a Hindu undivided family. So basically, I'm going to talk with the focus on individuals. Today, I'm not going to talk about how corporates can save tax. It's purely for an individual's point of view on how much tax you can save and how you can save tax by investing. Mind you, friends, let me also go back to the budget speech 2020. There has been a simplification of the income tax regime. The proposal is that we might move to a new tax regime where all these exemptions might be redundant. So the government has proposed it and it has implemented it. It has already been implemented and people had the option to choose if they want to move to the new regime or the old regime. I'm sure in one of the sessions that you've had on income tax, the topic has been covered. The tax slabs have been redefined, or you can say rejigged, but still the option has been given to an individual to choose if he wants to stay with the old regime or if he wants to move to the new regime. So the investment avenues I'm going to talk about broadly would be beneficial if someone is opting for the old tax regime, not the new tax regime. In case someone opts for a new tax regime, he or she would not be eligible for ATC nor HRA exemption and all that. Of course, these are not under investments, but there would be no exemptions offered to the people who have opted for the new tax regime. So going back to the erstwhile tax regime, these are the various investment avenues which are available for an individual to save tax. The most popular being public provident fund, and of course you have the employee provident fund. You have various other options like tax saving bank deposits, or this also could be a postal deposit. Then there is a national savings certificate. Then there is senior citizen savings scheme. There is Sukanya Samriddhi Yojana, unit linked investment plan, which I'll be explaining it to you in detail. Then there are endowment plans, which are again offered by insurance companies. Then there are equity linked saving schemes, which are popularly called tax saving mutual funds. And coming from the mutual fund industry, will be more enthused to talk to you about ELSS in general. And then, of course, there is NPS. I pointed out about NPS in the previous slides as well. You get the benefit under ATCCD when you invest in NPS. So it's an extension of the ATC benefit. And there is also an additional tax benefit of 50,000. I'll come to it at a later stage, but let's discuss about each of them at length now. Firstly, you have the option to go for a public provident fund. The most simplest choice of investing and saving your tax is going and opening an account, a public provident fund account for yourself. So how can you open this account? This account can be opened in any of the scheduled commercial banks, or you can go to any post office and open an account. Each individual is eligible to open only one account, and you need to have a unique account. Every person has got only a single account option, which is eligible when it comes to a public provident fund. The minimum amount that you can invest in PPF is 500 rupees, and the maximum in a year can be 1.5 lakh. So under ATC, the benefit extended to save tax is to an extent of 1.5 lakh rupees. So an option that you have is to put 1.5 lakh rupees in your PPF and take straight away 1.5 lakh rupees exemption on the income that you have earned. The PPF as a choice has got a 15-year lock-in period. So when you start investing in PPF, so if I open an account in 2020, I would be able to withdraw all my money only in 2035. So with a long-term view, it is recommended to have an account in PPF. So the funds cannot be withdrawn in the term which is less than 15 years. However, there are options such as a loan which you can take against your own funds in the PPF. The investments can be made on a lump sum basis. That is, you can go and deposit it all the way till 1.5 lakh, or you can make smaller investments. That is, every month 5,000, 10,000, or whatever amount that you feel suitable. But the total should come up to not more than 1.5 lakh. You can plan your investments accordingly. It depends on the cash flow also that you receive in the form of salary or any other income that you would have. So the eligibility is that you cannot make more than 12 yearly payments. So you can do only a monthly, PPF installment, or you can make your 1.5 lakh investments in 12 different installments. One thing is that you need to invest at least 500 rupees every year to ensure that your account is active. If the investments are not made in a particular year, then the account would, be inactive, and then you need to pay a small fee to reactivate it. So I was mentioning about the loan amount. So a loan can be availed against the investment amount. Say, for example, I, as an individual, have been investing 1.5 lakh rupees every year in my PPF account that I hold with a particular commercial bank. So 5 years or 6 years down the line, I have invested close to about 9 lakhs, and then also there is an accrued interest portion to it. So the amount which is accumulated, I'm assuming that it is close to about 10 lakhs now with accrued interest. I can avail a loan of up to 2.5 lakhs on the total accumulated amount, and then I can also opt to repay the amount in the next 36 months. So this is basically a loan which I'm taking against my own PPF balance from my PPF account. How and when, how and who is going to pay your interest on your PPF account? That's a question that you would have. So public provident fund, all the investments made by individuals in public provident fund are accounted under Money One, M1, with the government of India. So the central government or government of India is going to pay you the interest on all your investments in public provident fund. Currently, interest rate offered on PPF deposits is 7.1% annually. So when it comes to the latest interest rate, the interest rates in general for public provident fund and most of the other small savings scheme is reset on a quarterly basis. This decision was taken in the year 2017, 16 or 17, where the government of India felt that the interest rates being paid on most of the small savings schemes is very high when compared to market rates. That is the reason they have linked the interest rate being paid on public provident fund and all the other small savings schemes. When I mean to say small savings schemes, I'm talking about your Kisan Vikas Patra, your senior citizen savings scheme, your national savings certificates, etc. So I'll anyway cover a few of them shortly. So the government has decided that the PPF interest rate would be linked to a 5-year government security rate. So government of India borrows bonds, issues bonds and borrows from the market, and these bonds trade at a particular interest rate, or you can call it yield. So based on the yield at which a 5-year government of India bond is trading, your PPF or your small savings interest rate is decided. They would want to add a 50 basis point spread. 50 basis point is 0.5%. So they are adding 0.5% over the government security rate and offering you interest. How is the tax treatment on PPF? When I'm investing my 1.5 lakh rupees in PPF, I'm getting an exemption on my income tax up to 1.5 lakh. The gains which are accrued in the public provident fund account, the interest that is being deposited inside the account, even that is exempt from taxation. 15 years later, when I would want to redeem the whole fund, 15 years later, once I redeem the whole corpus is also tax-free. All the earnings that I have accumulated on public provident fund, including the interest as well as the principal, is completely tax-free. So this is one product which you can consider as a debt investment. So debt, I mean to say, it's kind of a loan kind of an investment. So this is one popular choice I have covered about, that is public provident fund. One of the other most prominent savings avenue is the employee provident fund. So for people who have worked so far, they would be knowing that a small portion of their salary, that is 12% of their basic salary. Generally, when there are components of salary, there is basic, HRA, DA, and other components. So 12% of your basic salary is deducted from your salary, and a matching contribution of 12% is made by your employer. Now, for example, you work in a company, and the company has got has a provident fund corpus. There could be two ways where a company can have a provident fund corpus. That is, one is a self-managed provident fund corpus. The other is a provident fund corpus being managed by Employee Provident Fund Organization, EPFO. EPFO is governed by Ministry of Labor, Government of India, and is the fund manager and also maintains the balance of each and every individual who has an account with Employee Provident Fund. So as I was saying, say I have a basic salary of 10,000 rupees. 1,200 rupees, that is 12% of it, is contributed from my side to EPF. Similarly, my employer would be contributing a matching contribution, that is 1,200 rupees from his side to EPF. The 2,400 rupees every month is accumulated in my employee provident fund corpus, and the government of India declares a rate of return based on how much they have earned for the corpus as a whole. So again, when my 2,400 rupees is being invested in employee provident fund organization, employee provident fund organization in turn invests my money in various securities. That is, they invest in government bonds, they invest in corporate bonds issued by various corporates, they invest money in state development loans, they invest money in equity as well. So this is a new change in investment pattern where they have made it mandatory for employee provident fund organization to invest money in equity. That is, they go and buy, they participate in the share market. I do not say that they go and buy shares, but they go and participate in the share market through exchange traded funds. I'll come to that topic altogether at a later stage. I can deal with that in the question and answer session. So like I was saying, this EPF is a defined benefit as well as a defined contribution program. I'll explain it to you. It's a defined benefit. Your employer is contributing 12% towards your EPF. That's a defined benefit. You are contributing in a disciplined way 12% of your basic to your EPF, which is a defined contribution. So a defined benefit and defined contribution scheme together with an aim to create a retirement corpus. When you turn 58, or maybe in certain states it is 60, you would want to retire with a corpus. So India, friends, is not a welfare state. In India, you need to save for yourself, to fend for yourself. This is the hard reality. So it is very important for you to save your money in various avenues, and also, of course, save tax to an extent, and save your money to create a corpus for yourself. So you no longer have any organizations which would be paying you pension when you retire, when you're turning 60 or 58. So those are the days which are gone where governments used to pay pensions to employees. It is no longer available in any of the governments or any of the government jobs too. So coming back to what I'm talking about, EPF has close to about 11 crore subscribers all over India. It also covers people who are not a part of the regular workforce. It also covers BD workers. It also covers people who work in the tea farms. It also covers people who work in the silk boards, etc. So it covers both employees who are in the regular workforce and also employees who are not a part of the regular workforce. It also offers certain benefits like employee deposit linked insurance scheme, where people can avail treatment in the ESI hospital. It's in Sanat Nagar in Hyderabad, if you recall. So they can avail treatment in certain hospitals at nominal charges. So your 1,200 rupees, like I was telling you, 10,000 is my basic, 1,200 rupees is my contribution, and all through the year, 1,200 into 12 months, which will be close to about 14,000 odd rupees, 14,400. So 14,400 rupees, I can claim exemption from my income tax. So I can claim benefit up to 14.4 thousand rupees in my ATC, because this is my contribution to my EPF. Similar to how you have contributed voluntarily to PPF, here you are contributing to EPF voluntarily, and you can get the benefit to that extent to your EPF. There is another option called voluntary provident fund, wherein the option is there to contribute up to 100% of your basic salary to your provident fund. Of course, this is not done by, this contribution is done only by a very few people, where the salaries are generally very high. The other options which are available with EPF are that EPF offers you the option to avail a loan on your EPF corpus. You can avail the loan for various reasons. It could be your education, it could be a marriage, it could be your children's marriage, or any of the health reasons. So these are the various reasons under which you need to submit an application, and accordingly you will get a loan from your employee provident fund. Going back to the tax treatment of EPF, EPF again is exempt, exempt, and exempt. All your investments that you make are exempt from taxation. All your gains that you would be getting are exempt from taxation. And at the time of retirement, when you withdraw a significant corpus, again, the corpus and the interest is exempt from taxation. So EPF also offers an EEE regime when it comes to taxation. Next slide. Yes. So I would like to discuss about the other savings options which are available, being tax saving fixed deposit. So this is another popular option wherein people generally can go to any commercial bank, or it could be even a post office, where they can open a tax saving fixed deposit at with a 5-year lock-in. So here the investments that you make in this fixed deposit are locked in for the period of 5 years. You will not be able to withdraw your money for 5 years, but the interest which is built in, and when you redeem your money on the gains, you will be paying tax on it. So all your investments that you're making, say I am contributing 1.5 lakh rupees towards the tax saving fixed deposit with any commercial bank or with any post office in one particular year, and I would want to redeem this money at after 5 years, I'm going to pay tax on the gains that I have I will be getting after 5 years on my tax deposit. The rate of interest again on these tax deposits is dependent on various factors such as the interest rate scenario in the country. It also depends on the borrowing rates and also the lending rates. The borrowing rates today in India have been really low. Now, for example, if you would want to go and place a fixed deposit for yourself in State Bank of India for a period of 1 year, the interest rate offered on deposits has gone low all the way till it has gone low to all the way till close to about 3.5 to 4%. So a 1-year FD is giving only close to about 4%, whereas your 5-year FD is yielding you close to somewhere around 6.5 to not even 6.5%. It's close to about 6 to 6.25%. So that's the return that is on offer on your fixed deposit. So compare your various investment avenues. I'm talking about 5-year fixed deposit with a 5-year lock-in, and again, all your gains that you get after 5 years are completely taxable based on your income tax slab at that point in time. So the tax saving deposits are one. We have covered EPF. EPF is exempt, exempt, and exempt, but you can withdraw only when you retire. PPF has got a 15-year tax, 15-year lock-in period, and the rate of interest currently is 7.1%. Interestingly, I missed out on the rate of interest which is being offered on EPF. Employee Provident Fund currently offers 8.5% interest. So this again is a debatable topic. How is Employee Provident Fund able to declare such a high interest rate compared to any of the other savings options? Is the answer lies with Ministry of Labor and Ministry of Finance again. The investments that they make is hardly yielding them close to about 7.5%, but still they have declared a rate of return of 8.5%, which is again for a great benefit of all the subscribers to EPF. So I would suggest that you make sure that your retirement corpus is being built by utilizing the EPF option. And friends, make it a very have a disciplined approach towards your retirement. Please make sure that you do not redeem your withdraw your EPF corpus for any reasons. Just ensure that this is your retirement money and keep it till the age of 60. That's an advice that I'm giving you. The other popular option is National Savings Certificate. Even this counts under small savings scheme offered by Government of India. So this is nothing but a certificate which is issued by Government of India, where it's like a bond. You pay the government 1,000 rupees. The minimum investment, of course, is 1,000 rupees, and it can go all the way till 1.5 lakh rupees. The certificate can be purchased by a single adult or jointly by 3 adults. It can also be subscribed by a minor who's about 10 years, and it can be subscribed by an adult on behalf of a minor and a guardian on behalf of a person of unsound mind. So the tenure for this is 5 years. Again, there is a lock-in for 5 years. These national savings certificates do not offer any kind of a liquidity. That is, in case you would want to redeem your investments, there is no option that you can redeem them and get back your principal amount here. The total interest accumulated at the maturity is again taxable. It is unlike PPF. It is very similar to a 5-year term deposit. I just mentioned that in a 5-year term deposit, when the term deposit matures, the interest portion of it is taxable. Similar is the case with national savings certificate. But what is the difference between NSC and a term deposit? The difference primarily is that term deposit rates are again defined by banks as such, but this national savings certificate returns are announced by Government of India. The reset period is again quarterly, and then it is dependent on how a 5-year GSEC is trading in the secondary market. So that's another popular choice of investment, which is national savings certificate. Senior Citizen Savings Scheme is one more scheme which is available where you can get an income tax exemption up to 1.5 lakh rupees. All this falls under ATC, re-emphasizing that fact. So this can be availed by individuals who are over 60 years of age, and also by individuals who are over 55 years and under 60 years who have retired or have taken VRS. They can only go for the scheme. The tenure again for this investment option is 5 years. The depositors can open a joint account with their spouse. The investors can open multiple accounts, but the total amount should not go beyond 15 lakh rupees. So now, for example, I have multiple accounts. I cannot save more than 15 lakh rupees in Senior Citizen Savings Scheme. This generally has a little higher interest when compared to your regular PPF or any other savings options. But still, you can compare it with bank FD. In a bank, in general, there is a 1% additional interest being paid out to senior citizens. So similarly, the Senior Citizen Savings Scheme has got a little higher interest when compared to any of the other fixed income savings options. So the investor can close their accounts before maturity, but there is a penalty attached to it. If they close it before 1 year, there is no interest being paid on it. In case the interest is already paid, it will be retracted from the principal which is already given to them. After 1 year, 1.5% of the deposit will be deducted as a penalty, and after 2 years, an investor will be penalized with 1% of the deposit. All this, I'm talking about premature withdrawal, that is withdrawal before the period of 5 years. On maturity, the investor can extend this tax saving scheme tenure for 3 more years. So someone who has opened a 5-year senior citizen savings scheme can opt and extend it for the next 3 years too. The scheme qualifies for tax deduction under ATC, as we have discussed, and however, TDS is applicable if the interest amount exceeds 40,000 rupees in a year. Another scheme which was introduced not long ago, it was been recently introduced, and it is in line with the government's Beti Bachao Beti Padhao initiative. It is the Sukanya Samriddhi Yojana. Sukanya Samriddhi Yojana is under ATC, it is covered under ATC, and a legal guardian can open an account for his or her girl child. And only one account is allowed for one child, with a maximum of 2 accounts in a family. So that is, you can actually open 2 accounts if you have 2 girl children. So this account can be opened for girls with age below 10 years. Immediately after they're born, you can open an account with Sukanya Samriddhi Yojana. The tenure for this scheme is 21 years. So till the time the girl, attains the age of marriage, or till the girl turns 21. If you have opened the account when she is born, you cannot withdraw your funds. For instance, if a girl is 7 years at the time of age of opening, the account will mature when she turns 28 years of age. Individuals have to make deposits for 15 years, and if you do not pay at least for 1 year, then the scheme will be, then the account will be dormant, or it will be discontinued. Then you can revive it by paying a nominal fee and the minimum deposit for the year. The minimum deposit for the year is 50 rupees, and it can go maximum up to 1.5 lakh rupees. The premature closure is allowed on the occasion of account holder's marriage. That is, if the girl is marrying, as I told you, attainable marriage age is 18 years as of now. So if the girl wants, if the girl has to be married, then the account can be closed and the proceeds can be utilized for her marriage. And but still she has to reach the age of 18. Apart from that, emergency premature withdrawal is allowed, provided the investment has been made for a minimum of 5 years. Also, friends, there is one more option of utilizing the funds in Sukanya Samriddhi Yojana for the girl child's education as well, which I have not put it up on the slide, of course. This again offers the benefit under ATC. The interest rate offered on this is very attractive. It was 8.4 some time back. I guess during the reset in the last quarter, it has come off and it is close to about 7.9. Let me talk to you about
पहले ही याद ही नहीं रहा मेरे को, थोड़े से थोड़ा खा के चुप मांगते हैं ना, खाना दियो बोल के।
बोले
request participants to mute yourself. Thank you. So I would like to also talk to you about the various insurance plans which are available where you can avail the benefit of ATC. Insurance again is a very popular option of availing ATC tax consideration. And one of the most popular insurance products is ULIP, which is Unit Linked Investment Plan. So ULIPs basically are market linked investments where you subscribe to an insurance policy, and being a policy holder, your money is again invested in the equity markets. Some money is in the debt markets, some money in certain balance funds. Of course, you also get the benefit of life cover. So as I was saying, ULIPs are products that provide you a combination of life insurance policy and also an investment opportunity in a single plan. ULIPs are provided by life insurers. So your payments to these companies when you buy a ULIP plan are called premiums. So so the premiums could be a monthly premium, or it could be a quarterly premium, or there's an option of an annual premium. So ULIPs are more similar to insurance plans, like how I was mentioning. You get the risk cover and also the choice of investments of your premium amount when you are participating in a ULIPs plan. So a portion of your premium is diverted towards the investment and is managed by professional fund managers. A ULIP insurance plan comes generally with a lock-in period of 5 years. So you must have received, I'm sure, calls from various insurance companies like a Bajaj Alliance or an ICICI Life Insurance or a HDFC Life, where they talk to you about investment plans also, which cover your insurance. They also offer you insurance cover. These typically are unit-linked insurance plans. They tend to explain it in detail if you participate in the call further instead of just saying no, I'm not interested. So again, as I said, there are equity-oriented ULIP funds, there are debt-oriented ULIP funds, and there are balanced funds. So every month, if I'm paying a premium of say 50,000, every year if I'm paying a premium of close to about 50,000 to 60,000 rupees, out of which a small portion is utilized to cover my life. That is, there is a term premium being deducted from it. I generally get a cover of say 1 lakh or 2 lakh rupees in case there is some kind of an accident, or in case something happens to me, then my nominee would get the cover of up to that said amount of 1 lakh or 2 lakh rupees. The rest, 35 to 40,000 rupees, whatever is there, is being utilized to participate in the equity markets, or it could be a debt market participation. That is, your money is invested in bonds, or your money could be invested both in equity as well as debt. So these are balanced funds. So this is a very, very popular investment avenue. Life Insurance Corporation of India has the largest ULIP book. They manage total assets to the tune of 23 lakh crore. That is the asset under management by Life Insurance Corporation of India, LIC of India, out of which the ULIP book is quite significant. Let me also talk to you about various other policies which are available with life insurance companies apart from ULIP. You have endowments policies, which again are a popular investment avenue. So endowment plans are among the most popular insurance products in India because it combines a twin benefit of investment and life cover. Like I was mentioning, similar to how a unit-linked plan is there, it also gives you a kind of a investment angle to it, and it also covers your life. But the basic difference is that endowment plan does not have to tell you on where the investments are being made. In a ULIP plan, there is a disclosure of the portfolios. Every month, the insurance company generally discloses on where the investments have been made. Now, for example, if you subscribe to a ULIP plan of ICICI Prudential Life Insurance, you will know that your money is being utilized or invested in certain companies. They are buying certain shares or they are buying certain bonds. Whereas in an endowment plan, you do not have that flexibility or feasibility, or there is no clarity on where your money is being invested. Still, it is a popular option. The returns that you can get on ULIPs is purely dependent on market returns. So this is a very generic term which is used, market returns, because if the equity markets tend to do very well, your ULIP returns could be good. If the equity markets tend to not perform well and there is a kind of an market crash, then your ULIP funds might give you negative returns or might not give you back your principal. But in general, endowment plans ensure that you get back your principal and also you get enhanced value to that. So it is similar to ULIP plan, like I was mentioning. However, it differs in several ways. When you invest in an endowment plan, you're getting life cover as well as you're saving money for your retirement. So the vision of an endowment plan is for the next 20 years or 25 years. You have a 15-year plan, 20-year plan, 25-year plan. You're saving for your retirement. You're saving for your children's education. You're saving for their marriage, or you want to purchase a house. You're putting away money in an endowment plan. So the policyholder's family or the nominee, as I was mentioning earlier, gets the sum assured in case of death of the policyholder. In case the policyholder survives the policy term, that is the 15 or 20 or 25-year term, he gets back the maturity amount plus any bonus accrued in the endowment plan. I can name a plan like LIC of India has got a popular plan called New Jeevan Anand, which is an endowment plan, and it is one of the most popular plans in the endowment space. The benefits of these endowment plans include financial protection of the family against policyholders' sudden death or permanent disability. It also offers savings based on the important life goals such as retirement, house purchase, or children's marriage or education. You're saving with a goal in mind. You have a 25-year tenure in mind, and you're ensuring that you're saving your money or you're putting away your money for your retirement. So that's a goal-based investing. It also offers you exemption under ATC. Of course, there is an option to avail a loan against the policies of most of the endowment plans in case of any financial emergency. So these are, broadly the endowment plans. Let me spend a little more time on this avenue, which is equity linked savings scheme. ELSS, which is also, commonly known as tax saving mutual fund investments, have gained a lot of prominence thanks to the various advertisement activities which have been taken up by Association of Mutual Fund India, and also a lot of investor awareness programs which are being held with the mandate given by SEBI. You today have a lot of advertisements coming in popular TV channels, in most of the shows, even during IPL, which has major eyeballs, where it says mutual fund sahi hai and mutual fund sare navi in Telugu, and there is a lot of investor enthusiasm regarding mutual fund investments. So equity linked savings scheme is one option of your gaining a tax benefit. That is, you can invest up to 1.5 lakh and you can gain an exemption up to 1.5 lakh. Of course, there is no limit of investing in an ELS scheme. You can invest up to 2 lakhs, you can invest up to 3 lakhs. There is no limit on how much you can invest, unlike how it is in public provident fund. Going back to PPF, you cannot invest more than 1.5 lakh rupees per month. Similar is the case with many of the small savings schemes. Whereas in an equity-linked savings scheme, there is no limit on how much you can invest, but the tax exemption on the whole for all your ATC put together will not be exceeding 1.5 lakh. Now, for example, I as an investor have invested in PPF. I have taken an NSE. I have also I also have a term insurance plan for myself. I have a ULIPs plan for myself. I have an endowment plan for myself. I also invest in ELSS. All my investments put together, I can claim an exemption only up to 1.5 lakh. That is, now if I'm investing 50,000 in my PPF, I can claim exemption up to 1 lakh rupees on all the other investments that I have. If I'm paying 15,000 rupees premium on my insurance policy, it is, has to be deducted in the leftover 1 lakh rupees. So that 85,000 can be invested in a mutual fund, and I can get the ATC benefit only for that portion. So that is how broadly ATC works. And coming back to explaining the ELSS scheme, these are the investments with the lowest lock-in period. We have discussed various investment avenues and the lock-in period available for each of them. You have a 15-year-old product, you have a 21-year lock-in product, you have a 5-year lock-in product, you have your FDs, which are again 5-year locked-in. ELSS is a 3-year lock-in product, which is the lowest amongst the category. So the lock-in for all your investments that are in ELSS schemes, that is equity-linked savings schemes or tax saving schemes, is only 3 years. Every mutual fund house has one scheme in their various scheme offerings, which is an ELSS scheme. For example, SBI has got SBI long-term equity scheme. SBI mutual fund manages it. Axis Mutual Fund has got Axis long-term equity scheme. HDFC Mutual Fund has HDFC tax saver scheme. Similarly, ICICI Prudential has some other scheme, and then Birla Mutual Fund has got Birla Tax 95. So there are various schemes, one scheme by each fund house. Overall, there are 40 mutual funds in the country, and there are 40 schemes which are available for you to invest in. What happens to the money that is invested in the ELSS scheme? The money that you invest in ELSS scheme is invested in stocks of various companies. So the fund manager, there is a fund manager who professionally is well equipped and he's also trained to manage funds. He manages your funds, he invests your money on your behalf in various companies. The fund manager basically primarily is tending towards a large cap allocation. That is, he goes and buys large cap oriented companies. That is, companies which are which have a huge market capitalization and which are well established in the country. He goes and buys companies like the State Bank of India. He goes and buys companies like Reliance Industries, Tata Consultancy Services, HDFC Bank, and all these, these are primarily large cap companies. So he is buying various shares with a view that the share prices will increase over a period of time. When you invest your money, as and when the equity markets do well, your principal also appreciates and you get good returns from your investments. Of course, there is a chance that your investments after 3 years might be lower than what you have actually invested. The classic case is the recent times. There has been, I recently was interacting with an investor who had invested in 2016 when the markets were trending and the markets were doing extremely well. His investments 3 years down the line, end of 2019 and the beginning of 2020, during the COVID time, when he just looked at his value of investment, it has diminished significantly. He has invested a lakh rupees, and the amount that he would get on redemption would be only 70,000 rupees. He was kind of worried. I've invested a lakh rupees and I'm not getting anything out of it. So that's how equities work. So that's the nature of your investment. ELSS is equity linked savings scheme. There is also a very high probability that your funds would give you very good returns if your holding period is long enough. The main reason why equity linked savings schemes have gained prominence is one, because of the low lock-in period, that is only 3 years, and secondly, people have realized that many fixed income investment avenues have been giving very limited returns, which is hardly enough to beat inflation. Coming to the concept of inflation, inflation is the price rise which you see in the economy. So the fixed income products which are available, that is a fixed deposit or your PPF or your any of the other NSCs, etc., offer you a return of close to 7%, 7.1%, 6.9 sometimes. But the inflation, the real inflation, the system, the economy is close to about 6.5, 7%. So your actual return is only 1% against what is compared to the inflation figures. So that is one reason people are interested towards looking at equity as an asset class for savings. So that is one more reason why ELSS has gained popularity. Uh, just to go through this slide quickly, as the name suggests, ELSS is an equity-oriented scheme with mandatory lock-in period of 3 years. In recent years, many taxpayers have turned to ELSS scheme to avail tax benefits. If you invest in ELSS schemes, then you can avail tax exemptions of the investment amount up to a limit of 1.5 lakhs. Further, the income that you earn under the scheme at the end of 3 years will be considered as long-term capital gains and will be taxed at 10%. I'll also tell you about the tax implications after you redeem. Now, for example, if you have invested 1.5 lakh rupees in your ELS scheme, and if the markets do well, and also the fund that you have invested has performed very well, say your investments of 1.5 lakh rupees has become 2,20,000 rupees. The gains that you have got is 70,000 rupees, and you have invested for a period of 3 years. Your gains have been 70,000 rupees. What is the tax implication on that? Because your gains are less than 1 lakh rupees, there is no tax that you'll have to pay on your ELSS investments. If your gains are in excess of 1 lakh rupees, that is, if your 1.5 lakh rupees has become 3 lakh rupees in 3 years' time, that is possible if the markets do extremely well. If your investments have doubled, or if your gains are 1.5 lakh rupees, you will have to pay tax on 50,000 rupees. That is the amount which is over and above 1 lakh, 50,000 rupees, and the taxation that you'll have to pay, the tax that you'll be incurring is 10% of it. That is 5,000 rupees has to be paid as tax. The rest is all income for you. So this is one more attractive proposition, that is long-term capital gains on ELSS schemes is comparatively very low when you compare the same with your NPS or with any of your fixed income products. I'll also give you a small illustration on how to come up with your returns expectation and how your returns would be. And I'll spend 5 minutes time after I finish the presentation on this. So the other features of ELSS is that 80% of your investments are in equity markets. The funds invest in equities in a diversified manner across market capitalizations, teams, and sectors. There is no maximum tenure of investment. There is a lock-in period of 3 years. The tax exemption under ATC is a benefit. Income is treated as LTCG and taxed according to the prevalent tax rules. This is on redemption. So this is about ELSS. And another popular savings option, you can call it the last savings option that I'll be covering today, is National Pension System. National Pension Scheme, NPS, is a government-sponsored pension scheme which was launched in 2004 for government employees. Later, it was opened in 2009 for the public, and today it has a total asset under management of close to about 3 lakh crore. That is 3 lakh crores of rupees is being managed by National Pension Scheme. You have various fund managers who are managing it, and the cost of managing NPS is absolutely low. You need to pay a fee for managing your funds, right? So NPS manages your funds at 1 paisa, that is 0.001%. So if you have invested 100 rupees, your money is being managed at 1 paisa. They're just going to charge 1 paisa and then the rest is invested in the market. There are various options of investing in an NPS, but there are certain clauses attached to it. NPS, the investments made by an investor in NPS cannot be redeemed till they attain the age of 60. So the lock-in period is not 5 years, 10 years, 15 years, 20 years, but till the age of 60. This is aimed at a retirement planning. So someone who has, who wants to choose a retirement planning product, NPS is one option. Even at the age of 60, the corpus that you accumulate, you cannot withdraw the whole money. You can only withdraw 60% of it, and the 40% of it has to be utilized to buy an annuity plan with an insurance company. What is an annuity plan? Now, for example, I have invested in NPS right from the current age of mine, and then when I turn 60, I would want to redeem the whole corpus. And when I turn 60, say my corpus is a crore of rupees in NPS, I can withdraw 60 lakh rupees, which is tax free, and then 40 lakhs has to be given to an insurance company, and that insurance company is going to pay me, a certain amount every month in the form of annuity. So this is an annuity plan which is offered by insurance company. The tax treatment earlier for NPS used to be exempt, and taxable, but of late in the recent budget, the tax treatment has changed, and it has made this investment option very attractive. It is now exempt, and exempt. So your 60% of the corpus, when you redeem it, you're not going to pay any tax on it. So this is another popular choice of investment. So apart from that, I've just covered broadly the various options or avenues where you can invest. I request the audience to mute themselves. Thank you. So as I was mentioning, these are the various options where you can invest, and there is something that you can invest on, and it is not something where you save taxes, but it will help you in a very long run. Invest in something which can give you the highest returns, that is education. Invest in self-development and philanthropy. Of course, sharing your wealth, when you create wealth, sharing a part of it with the underprivileged and also people who need it will take you, will keep them in their blessings, and also will take you along in a very long run. So that's broadly about the investment avenues and options which are available in when it comes to your ATC and other investments. One important point I also wanted to cover, but I missed out in NPS is, we were talking about ATC investments which are up to 1.5 lakh in, the eligibility is up to 1.5 lakh, but NPS offers an additional 50,000 under ATCCD. That is, it can go all the way up to 2 lakhs. So if you invest 2 lakhs in NPS, you can get the benefit up to 2 lakh rupees. So that's the benefit that is offered. Can you see my screen? Is the Excel sheet visible?
Excel sheet is not visible now.
Okay, just a moment. I need to share my Excel sheet.
Yeah, now it is okay.
Yeah. So I actually have tabulated the popular investment avenues which are available for investments. These might give you certain tax benefits. Some of them do not give you any kind of a tax benefit. And also the latest rate of return which is offered on all your investments. This is the latest rate of return as on November. So I'll go through all of them. PPF I mentioned in the presentation. The latest return offered on PPF is 7.1%. The taxation and remarks are mentioned. It's a 15-year lock-in product. Your bank fixed deposits, typically up to a 1 year fixed deposit is giving you 4.4%. This is SBI. And 1 to 3 year FD is giving you 5.1%. 3 to 5 years is giving you 5.3. 5 to 10 years is giving you 5.4%. So when I mentioned 6.25 to 6.5% return in your 5-year FD, it is you get that additional benefit because there is a lock-in. These fixed deposits that I'm mentioning do not have a lock-in. but there is a penal interest when you would want to redeem your funds. I've compared it with a leading private bank. HDFC Bank also offers a similar rate of interest on all their FD. Compare that with postal deposits. 6.7% was an old rate, but I believe this has been modified too, and it has been brought down significantly. Senior Citizen Savings Scheme offers much higher return. It is up to 7.4%. National Savings Certificate 6.8. Kisan Vikas Patra 6.9. Sukanya Samriddhi 7.6. 5-year post office FD offers you 5.8%. EPF latest return, which is declared by Ministry of Labor, is 8.5. NPS investments, your money is invested in equity, your money is invested in corporate bonds, your money is invested in government securities. Your blended return is close to about 9.7579, and of course, this is past return, and the same return cannot be guaranteed in the future. So that's how it's working. But let me also give you a comparison on how investments in certain equity oriented funds might be beneficial when compared to other fixed income products. Now, if I take the example of your 5-year bank deposit, this is the reason why ELSS has picked up. This is one more reason I'll give you. 5-year bank deposit, the latest return offered on it is close to about 5.80%. So this is the maximum return that you'll be getting. You invest 1 lakh rupees in a 5-year bank deposit. On a compounded basis, you would be earning so this is the return that you'll be getting on maturity. So if you invest in a 5-year fixed deposit with an interest rate of 5.8%, this is the interest rate which is offered on your 5-year deposit. Mind you, the gains that you have, the gains that you have got on this is 32,500 rupees, and it is completely taxable. If you fall under a 20% income tax slab, then you need to pay 20% tax on this. So your actual returns here is only 26,000 rupees. Compare this with the most popular choice today, an equity linked savings scheme. It is not really right to compare fixed income product with an equity oriented product, but still the logic behind investing in equity oriented products is, on a long run, the economies tend to do well, and equity markets are a function of an economy. So if Indian economy does very well, then the equity markets also should be doing well. In fact, the equity markets should outperform your economy, because your economy also has agriculture, which is a major laggard in terms of growth rate. So I'm assuming a very conservative return of 10% on your equity investments, and your holding period to be the same 5 years. So your amount would be on redemption, your amount would be 1,61,000 rupees. So the gains that you have received is 61,000 odd rupees. You have invested for a period of 5 years, and you have incurred long-term capital gains. So there is no taxation. And just look at the difference on, just look at the difference that you can earn if you invest in a growth-oriented investment avenue like equity. So that's visible in front of you. So for the same reason, we've seen a lot of traction, especially from millennials, people who are born after 1980s, who have opted for equity as an asset class and who have a vision or a long-term goal. They have been opting for ELSS as a product. So that's about ELSS. Just wanted to spend some time on equity as an asset class. And with this, I would like to open the floor for questions. I encourage the participants to ask their questions. It could be a chat or it could be on a call.
Yeah, you have any questions? Please post in the chat box. Yeah, somebody is asking which scheme is getting more, we get more benefit.
So when it comes to the word benefit, it is quite vague. If you ask me, it completely depends on the investor's appetite. For example, as an investor, I would want to invest in equity, and I have a horizon of 5 years. I do not need money in the next 5 years, and I can wait for 5 years to get good returns. So I would prefer equity. If I'm close to about 55 years old and I would need money in the next 5 years, I would look at something like a retirement plan. I would look at something like, a national savings certificate where I can get back my money in the next 5 years. So it depends on what is your risk appetite. It also depends on how you plan your investments. There are various factors, but for as I said, for millennials, if you have a really long holding period, you should invest in your money in equity. You should start investing in mutual funds. SIP is one way which I have been recommending to most of my investors. You should be starting an SIP, small amounts, but it will go a long way.
Yeah, somebody is asking about the career opportunity.
Career opportunities in tax stream, there are various options where you can make your career.
Tax stream, any possibility of career development? They're asking that.
Friends, I would, if the audience also has certain postgraduate students and graduate students, my sincere advice to them is, to keep in mind that whatever career opportunity comes your way, you should ensure that you work towards it and work towards excellence in that field. Now, for example, there are a lot of professionals in the field of taxation. There are chartered accountants who do extraordinary work in the field of taxation. So a commerce graduate sometimes chooses to become a tax professional. There are financial planners. You can take up certain courses like CFP, where you can get a holistic view about tax planning. You can get a holistic view about financial planning, your wealth management. There are courses such as CFA, where you have your financial analyst course that talks about various other opportunities in the financial markets. So to answer your question specifically in the domain of taxation, I'm not the right person, but yes, in financial services, the scope is huge. You can make a career in insurance. You can make a career in the sunrise industry mutual fund, the industry where I belong to. Banking as a sector is going to open up. There is some positive announcements from the Reserve Bank of India recently saying corporate houses might be allowed to participate and they might be given banking license. So it will open up many job opportunities for youth seeking jobs. So there are multiple places where you can make a career in. But whatever career you choose, you should work towards it and ensure that your service that you provide is excellent, and the turnaround time for solving queries or resolution is absolutely low.
Yeah, really. But one question from my side, Prithvi, is
Yes, sir.
the government is recently two this called plans are there, not new taxation system and old tax slabs are there. New slabs, old slabs are there. Really, it is going to be affected. All these investments because of new slabs. Really.
Yes, sir. So actually, there are the discussion which we've had internally as a mutual fund industry is ELSS as a product or ULIPs as a product has gained popularity because there is a tax saving angle attached to it.
Yes.
If there is no tax saving angle, why would I invest in a product with a 3-year lock-in or a 5-year lock-in? There is no incentive for an investor. So these products might be dead if at all the new tax system comes into implementation and the old tax regime goes out. The announcements made by the finance minister in the previous budget indicate that India is tending towards a no exemption kind of an economy where we do not want to have any exemptions such as even the housing or any other exemptions. Slowly, the thought process is that they would want to reduce the taxation rate as a whole, the blended taxation rate as a whole, and do away with all the exemptions which are offered currently to the people in general, sir. So that's the understanding that we have in the industry currently.
Yeah, because this tax planning, investments, and all those things, they are not only the individual benefit, it has also
Correct.
benefit to the economy, because where they are investing in different schemes like national savings certificates and all those things. So
Exactly.
indirectly they are boosting the economy in small savings, in addition to their getting their tax benefits and all those things. But why the government is removing the alternative plan and all those things?
So if you see, sir, we just looked up at some numbers. The total amount of money in the small savings schemes, all your NSC, your public provident fund, and all your other small savings schemes put together, does not exceed close to 2 lakh crore. That is the total quantum in small savings scheme. Government of India in a year borrows close to about 7 lakh crore. So when you want participation from small savings scheme, the total corpus that you built over so many years is close to about 2.5 lakh crore. But your government itself has such a big borrowing program every year. So for them, the government, it makes sense to pay lower interest for Government of India bonds compared to any of these small savings schemes.
Yeah.
So your small savings scheme fetches you 7.1%, sir. Government of India bond for a similar tenure will give you close to about 6.2. So government is paying lower interest on a government bond compared to a small savings scheme. So it makes economic sense for the government to scrap all these small savings schemes and go ahead with only government borrowing program.
Government bonds. Okay. There is a hidden agenda for that.
Yeah. So as a capitalist economy, we might move to that stage at a later stage, in a few years down the line. But still, we as a country are not neither completely capitalist, nor are we towards communist leaning mentality, or we cannot call ourselves completely socialist. So we are somewhere in between.
Yes. Yeah. Any other questions from audience?
There is one question which says, can you explain the reason for reducing interest rate on fixed deposits? So the reason is very simple. Now, the interest rates as a function will affect the economy as a whole. If you see, Reserve Bank of India, through their various monetary policy committee meetings, decides the repo rate, which in turn decides the lending rates in the economy. Lending rates again will in turn affect the fixed deposit rates for a saver. Now, as a saver or as a person who's saving, I would want to have great high rate of interest. But as a person who would want to take a loan, I would want to have a low rate of interest. You cannot have both. So if you would want a low interest rate scenario, that is, if as a borrower, you would want your housing loan to be very low, your housing loan to be close to about 6.95 to 7.1%. That is the current housing loan offer. Of course, your deposit rates also will be low, because banks as such operate on a net interest margin concept. That is, the difference between the cost of funds for them and the cost at which they and the money that they earn on their investments or their assets. Now, for example, a bank lends money at 7.5%. They borrow money at 6.2%. Then the difference is net interest margin. That is 1.3%. A bank is always profitable if the net interest margin is wide. So if a bank reduces the interest rate, if the bank reduces the deposit rate, the net interest margin increases. That is for the profitability. And also it is the government's initiative which is pushing the borrowing rates lower, which in turn is reducing the savings rates for the savers. There's one more question for long-term RD or FD, which is beneficial. So RD, FD, there is a very simple difference. FD is a lump sum investment. RD is a systematic investment. That's the basic difference. Now, for example, I have 1.5 lakh rupees to invest. I'm investing that 1.5 lakh in a single go. That's a fixed deposit. Recurring deposit is nothing but I'm investing 10,000 every month for the next 15 months, which is amounting to 1.5 lakh rupees being invested. That is an RD. So the asset class as such is fixed deposit. So you're investing your money in a fixed deposit, but when you're opting for an RD, it is basically spreading out the money over a period of time. The rate of return broadly on FD and RD will be very much, hardly you'll have a difference, close to about 25 to 30 basis points. That is 0.25 to 0.3%. So disciplined way, if you want to save your money, you're earning a salary every month. I would want to put my money 10,000 rupees every month. You should start an RD. If you have a lump sum money, if you get a bonus from your company, put your money in an FD. So that's basically the difference.
Yeah, I think enough. Ramesh sir, please take care about formalities. Ramesh, are you there?
Yes, sir. Sir is there. Yes, sir. Ramesh sir is there.
Ramesh.
Ramesh sir, unmute yourself. Ramesh sir.
Sir.
Ramesh sir.
Sir, thank you very much, sir. Sir, thank you very much, sir. Sri Prudvi Burgula garu. Am I audible, sir?
Yes, sir.
Yes, sir. It is audible.
Go ahead, Ramesh. Go ahead.
Okay. Sir, you have spoken at length on various investment avenues and tax considerations, and you have spoken on end use of taxes, legal tax avoidance, and what are the various investment avenues for tax savings. And you started your presentation with our finance minister's statement, "Sabka Saath, Sabka Vikas, and Sabka Vishwas."
Yeah, I think there is some problem with you, Ramesh. Anyhow, thank you very much, Prithvi, for accepting our invitation on behalf of the Usmania University. So
the pleasure is mine, sir. So looking forward to many more sessions. I hope this was useful. Thank you for all the kind remarks I have received in the form of comments here. Looking forward for many more interactions.
Yeah,
thank you all.
All blessings from our department, because one more important thing is Prithvi is our son of our HOD, Usha Kiran madam. So elder son is working. Thank you, Prithvi. Bye. Thank you.
Thank you, sir. Take care.
Yeah. So thank you very much. Yeah. All the participants, the next session is sir is ready, Indrakant Shekhar sir, and we have a break for 10 minutes. And instead of waiting for 5:10, we'll start by 5 o'clock itself. Another 10 minutes time is there. So we'll have some break, and after that again we'll join for last session. Okay, thank you.
Thank you very much, sir.
Ramesh sir, okay. Ravi sir, can I post attendance?
After joining Shekhar sir.
Shekhar sir, okay.
Yeah, just we'll start sharp 5 o'clock. We'll start the next session.
Short break for tea.
Yeah. Huh? Well, Yeah, I think all of you come back after a very good hot tea and done and come back. Yeah, shall we start, Ramesh?
Yes, sir. Yes, sir. We will start, sir.
Yeah, Sir is also ready. Sir is on the way on the
Okay, sir.
video.
Okay, shall I start, sir?
Yes.
So welcome back to the third day of our national level workshop. And in the third day's proceedings, we have had 2 sessions, starting with the tax planning. And secondly, we have listened to various tax avenues, tax investment provisions, opportunities. And now, in the third session, I have the privilege of introducing to you Dr. Indrakanti Shekhar, sir, who is Senior Assistant Professor in the Department of Commerce, Usmania University, Hyderabad. It is situated in Telangana state of our country. He is qualified in MCOM, MBA, LLB, PhD, and has a PG diploma in computer applications. He has over 20 years of teaching experience. His specializations include accounting, taxation, and e-commerce. And presently, under his supervision, 8 PhDs are being pursued by research scholars. And he is a subject expert and resource person for many institutions, including UGC Human Resource Development Center, State Government College Education, and State Government Social Welfare and Tribal Welfare and Intermediate Board Education. He was awarded as Professor of Commerce for the year 2018 by the Tutors Prize, Hyderabad, during Ideal Teaching Awards on 2nd October 2018. He published the 18 articles in national and international journals, and he presented 42 research papers in national and international seminars. He has published 4 books, and he has organized 4 national level seminars in the university. And he is also an income tax advisor. He visited Singapore for presenting a research paper on international ombudsman and got selected as discussant for US research papers. And he was additional controller of examinations for 4 years. And during his tenure, various reforms took place, like introduction of online application forms and introduction of online payment of examination fees, online evaluation. And he was the coordinator of UGC net coaching for 2 years. And during his tenure, funds were released by UGC Sero Hyderabad. And during his tenure, many students have qualified in the UGC net. And he was the coordinator for ICICI Bank add-on course for 2 years with university. And ICICI Bank MOU, and 32 students got appointed in ICICI Bank because of his pioneering work. And he rendered service as placement coordinator for 6 years. And many students were appointed in corporate sector like Genpact, Capital IQ, Deloitte companies at University College of Commerce and Business Management and University College for Women Koti, Usmania University. And he also coordinated many students' education tours to Kerala, Kanyakumari, Bhadrachalam, and Vishakhapatnam. He is also coordinator for Student Youth Festival and competitions. He is a member in editorial board of Manjira Journal for Research in Social Science, GDC Jahirabad. He is an executive committee member in Telangana Commerce Association, and he is a member in All India Commerce Association, All India Accounting Association. He is a member in Bar Council of Hyderabad and Usmania University Teachers Association. And he will speak about 26 AS form and e-filing, which is much sought after topic. And with this brief introduction, I welcome you, sir, and please take over, sir. Thank you very much, sir.
Yeah, Shekhar sir, are you available?
Sir, I am ready, sir.
Yeah. You can start, sir. You can start.
Session started.
Right.
Yeah. So I'm very happy at the outset. Am I audible?
Yes.
Yes,
Yeah.
sir. Yes.
At the outset, I'm congratulating the organizers. I'm very happy that my friend Dr. Ravi Kumar is conducting the income tax and the GST workshop for 7 days. I'm so happy. Actually, this seminar is meant for taxation and GST people who are eagerly waiting for the e-commerce and how to filing online and everything. I'm very happy because now the time is around 5 o'clock. Still 127 participants are available. So we can understand the interest and participation interest and everything, how the people are participating in the seminars. So this is one of the success for the organizers. I'm very happy to involve in this privileged seminars. So let us have our presentation. So can I share my screen now?
Yes. You are the co-host. You can.
Yes, sir. Okay, sir.
Yeah.
Yeah, sharing, sir. Sharing your screen.
Back. Yeah. So I think many speakers have already discussed what is taxation, what is the heads of income, what is the many things in the taxation system. We will have a brief discussion about income tax, and also will come into the GST and other things. So the topic is given for me is Form 26 AS and also e-filing. So before going into that, we'll have a small review in the income tax. So introduction of tax, how it was started. Of course, the many people have already experienced, but just I want to make a review. Introduction of tax in India by Sir James Williams in 1860, and we have Income Tax Act 1925. So why I am mentioning all these things means, so income tax, maybe if you take direct taxes or indirect taxes, so these two are very important information which very impacted in Indian economy and Indian independence. I think everybody knows what is Uppu Satyagraham, tax on salt. So tax on salt, it was hesitation is started. When the hesitation is started, so they because of the England rulers have made 200 years ruling by India. Then what happened after that? They are imposed a tax on salt. So tax on salt, then natural resources. When they are imposing tax on salt, then our elders, our people, our freedom fighters have made a hesitation that how to make, then why they are making on this particular taxation system. Then they started with tax on salt, the hesitation, everything comes, and it is one of the major impact for getting 1947 independence. That's the reason I am intended to tell why the income tax and other taxes are impacted for our independence. And third point, we can see Indian economy. We have a mixed economy, as we have socialistic futures are there, and we have capitalistic futures are there. So we are in mixed economy. Definitely, our intention of economy is we need to collect the taxes from the rich people, and it should be implemented for the poor people. So here, sometimes it will be asked in the examination, maybe in competitive examination, what is the purpose of tax? The purpose of tax is the welfare of the public. So that, because sometimes in net examination, competitive examination, they will be asking. So public expenditure accounting, that is all different. We cannot discuss all these things, but so only one word answer, what is the purpose of tax? Tax is the purpose of welfare of the public. So this mixed economy, we have to be collected tax from the rich people, and it should be implemented for the people, poor people, so that the economy will get level. So that is the intention of taxation. And many speakers have already discussed, but once again, I wanted to make one different view of taxation in this. Then Indian taxation system, we have two important acts. So before that, we'll just look into after independence 1947. Then our Indian government, after independence, immediately they clearly decided that there is no taxes in India because they are suffered. Indians are suffered because last 200 years the England government has imposed a lot of different taxes, even lost in the tax on salt also. So because of that impact, government has decided there are no taxes implemented in India. But in the Nehru government, what happened? There are big issues that we need to require many funds for the establishment of canals, establishment of roads, establishment of infrastructure, many things. Then again, government rethinking that how to make income tax and how to make other taxes. They constituted a committee. Finally, 1961, our own government has started Indian Income Tax Act 1961. Then in Indian taxation system, as we are experiencing, there are two taxes: direct tax and indirect tax. Then direct tax and indirect tax, as we know, we have income tax, wealth tax, gift tax comes under direct taxes, and indirect taxes we have many things as service tax, sales tax, and customs duty, central excise. These are all. So now there is a requirement because 1956 Companies Act have already changed it to 2013. So Indian income tax is 1961. Now the modern days we need to change the taxation system. So what is the need of doing all these things? Then the government constituted Vijay Kelkar committee. So Vijay Kelkar committee has constituted and they are recommended new direct tax code in the year 2010. Of course, it is implemented in the parliament. It was passed, approved in the parliament also. But by the time Congress government is not exactly implementing that new direct tax code, what is the outcomes in new direct tax code? NDTC. NDC, somebody says NDC, but NDTC is correct abbreviation. So what is the outcomes in Vijay Kelkar committee? So here, if you take any salarized person's income, you can check it out, maybe after exemptions, maybe after deductions, exemptions, everything. You can see if your salary per annum is 10 lakhs, then finally after taking all exemptions, you can see your taxation will be 1 lakh. Means if you're earning something, almost all 10% taxation is compulsory to pay. Of course, it is not rate 10%, but anybody, you can take your salary form 16 or something or any other income, you can take, and finally how much tax you are paying, you can just compare it. So it is coming to nearer to 10 to 15% after taking 10%, 20%, 30% exemptions, individual exemptions, everything. So this is the survey made by the Vijay Kelkar committee. In that survey, many people they are inquired. So including chartered accountants, tax practitioners, and professors and teachers, and who are tax students. They opened a website and they asked all the opinions from the different public. Then finally they concluded the 10% is the correct taxation system. So the tax revisions are required. They wanted to make the 10% slab. So here the layman can understand what is taxation in India. Very simple. Up to 10 lakhs, no tax. After 10 lakhs, 10%. Simple. That's all. No other provisions, no other deductions. These are all. It should be very simplified so that block money can control and the foreign investments can be controlled. Our Indian people, block money, they are depositing into the Singapore bank or something, somewhere in Switzerland, somewhere like this. So if you want to get back that money, you have to streamline the income tax system and all the taxation system in India. So these are all the fruits coming from the Vijay Kelkar committee in the new direct tax code. But of course, many in the situations like government is having a lot of problems, then they made it into the different ways. Then finally, new direct tax code is not implemented, but government is thinking. Then after Modi government, what they wanted to do is they wanted to make single country, single taxation system, one India, one tax. Then what to do? One India, one tax. Then now there are two major taxes you can see: income tax and GST in India now. Of course, we have central excise, we have customs duty also. They wanted to make convert into GST later. Maybe we'll look into the future how it will be happen, but it is there. There is a vision in the BJP government that they wanted to make all indirect taxes clubbing into GST. then that is indirect taxes and income tax. And their intention is, if everybody is having GST number, everybody is paying GST, then every transaction, every individual is having GST number, and merchant and seller and middleman, everybody, if they are in the future, if they are paying GST in every transaction, there is no need of income tax in future. So now they are planning for income tax and GST may be clubbed, then we'll get it one tax, one India. That is the future plan of BJP. But how much it will be implemented, how government will be sustaining, and what next government will come, whether all these things we cannot predict. So anyway, so this is one of the way they wanted to change into new direct tax code, something by the other government. So anyway, we have goods and service tax. We are implemented 2017 onwards. We are experiencing that, and how it is implementing everything. We are looking into that, and many speakers are speaking about with GST also. Then after in the changes of the taxation system, we have compulsory TDS Act 1999. So before that, TDS is not compulsory, and people are not paying individually. Voluntarily, they are not paying taxes. Then government decided in 1999 better to introduce TDS system, so that wherever source of income is generating, there itself tax has to be deducted. So this is major implication in the taxation system, so that wherever income generating, the tax is automatically deducting. Like salary, if you're getting, employer is deducting your deduction. Like house owner, if you want to take a rent, the tenant has to deduct. Of course, domestic houses, it's not possible. If it is a big building, commercial building, or bank situated in one building, bank people will deduct the TDS, and the remaining rent amount will be paid to the owner. So this is practice is there. This is all the things is going on in the society. And let us come to the next, compulsory filing. Then we have many systems, many changes in the filing system. Manual system is there. If you want to submit your manual system, then you should have the minimum income levels and basic exemption levels. You have to check your own. Then you have to submit your filing system. So in the filing system, we have income tax return 1, 2, 3, 4 are there. Whichever income tax return is applicable, you have to file that income tax return manually. Then slowly it was changed into some other way. Then how it was happened is, the people are looking into different way. Then how they are making is, so this, if you are exceeded 5 lakhs rupees income, then definitely you have to be submit your income tax online only. So like this, there are a lot of changes. Then earlier, the 8 schemes, if you have cell phone, if you have four-wheeler, if you have urban land, if you have something like this, definitely you have to file the returns. If you have tax levels or not, but you have to submit all these things. So these are all the many things happened earlier. But now what happened? If everybody is coming to the e-filing is best now. So if you have nil return, if you have anything, if you are maybe more than 2.5 lakhs or whatever it is, if you are submitting online, you will be getting some of the benefits. That benefits will look into the next slides. What are the benefits we are getting? And now the government is asking for compulsory e-filing. Compulsory e-filing is made some certain rules that if you exceeded 5 lakhs, you have to go for e-filing system. But even 2.5 lakhs below people also can go for e-filing system, so that they will get some advantage. We'll look into the next slides. What are the advantages of e-filing? We'll go into next. So let us have some, am I audible, Venkatesh?
Yes, sir.
Yeah, yeah.
Yes, sir.
Right. So here we have a little bit slabs for individuals, because before going to the e-filing system, we need to know what are the slab rates and flat rates. We have two types of income tax rates. Flat rate system is there, and slab rate system is there. We have 5 heads of income, as yesterday's class you might have experienced with the Bhavani madam. So that salary, house property, maybe business, capital gain, and professional income. These are all 5 heads of other source of income. Like this, we have 5 heads of income. Out of 5 heads of income, Three heads, we can take it as normal income. One head is special income. Another one is casual income. So all slab rate comes into the normal income. What is normal income? Normal income is a transparent income. What is transparent income? Salary, house property, business income. These three are, we have certain ways to find out what is the exact income. It is a transparent. Salary income, you can find out with the employee, employer who are making all these things. You can find out salary is a very transparent. And house property, as we know, we can find out from the municipal authorities, we can find out from the income tax authorities, judicial authorities, we can find out from your neighbor, fair rental values and actual rental values. You can ask tenant and owner. There is some ways to find out house rent income. Like that, business income, we are all sometimes commerce people, we are all preparing the income and expenditure and balance sheet and P&L account. It is a transparent document, anybody can see. It is a transparent income. These three income heads we can treat as normal income. Normal incomes are affected with this slab rate. So this is the slab rate. So because it's a normal income, transparent income, you will be getting some exemption. Up to 2.5 lakhs is exempted. Then between 2.5 to 5 lakhs will be 5%. Then 5 lakhs to 10 lakhs is 20%, and more than 10 lakhs is 30%. As everybody knows, this slab rates, and health and education says 4% additionally will be imposed for everywhere. And we have some criteria that individuals and senior citizens and senior super seniors, like this, we have some 80 years above people. So these are all some of the slab rates we can experience. And as I'm already mentioned, salary income, house property income, and business income, these three comes under normal income. And we have special income. Special income is capital gains. Under capital gains, we have LTCG, long-term capital gain, and STCG, short-term capital gain. This will be taxed with the flat rate system. Of course, it is not mentioned in this slides. It is a flat rate system, either 15% or 20% directly will be imposed. That is special income. Then come to last income, income from other sources. That is also will be imposed flat rate system, directly 30%. So some of the income heads will be imposed with the flat rate. So normal incomes and these are all income from salary, house property will be slab rate. So that is the system what we are following in the income tax. Then let us come to the computation of total income and tax liability of an individual. So when you are going for computation of tax, you need to know what is the individual person income, what are the heads of income, which we are experienced, and as a partner of the firm, what are the incomes you are getting from the partnership firm, and if you are a co-personer in HUF family, what type of income you are getting. As an individual, if you are getting income from 5 heads, income from firm, income from as a business, income from HUF, income from other activities, if you are getting all these incomes will be taken into the total income. If it is already taxed, first you take into the GTI, then you can exempt already taxed income. So these are all the systems we just understand before going to the e-filing. This is the basic fundamentals, how to compute the total income. Then if you want to compute total income, certain important issues have to be checked before coming to that. So what are the steps in getting this tax liability? We have determination of residential status, because if you are an individual, your tax is different. If you are an Indian resident, your tax is different. If you are non-resident Indian, your tax is different. If you are a foreigner, your tax is different. So it's depending on your residential status. If you are having a totally domestic income, then it will be imposed on the complete taxation system what it is implemented in India. If you are an NRI, sometimes you are getting income in India, income getting from the foreign. So that also will be calculated depending on that. Two incomes tax will be imposed on only on Indian resources. So like this, we need to check all the points. If you are a foreigner, there is no taxation in India. If you are getting Indian resources as a foreigner also, you have to pay tax. That is the general rule. Mute చేయాలి. Next, step number 2, classification of income under different heads. As we know, earlier we have discussed salary, house, property. These are all heads of incomes have to be defined, differentiated, and every head of income will be having their own exemption. If you take an example of salary, section 16 exemption is there. If you take house property, section 24 is there. If you take business income, section 32 depreciation is there. Then if you look into others, so section 52, section 54, section 57, these are all exemptions are there in different heads of income. So if you classify the income, you can make the deduction of each individual head of income. Then step number 3, if you see exclusion of income not chargeable to the tax. So some of the incomes which are not coming to the total income, that you have to check. Then computation of income under each head of income, definitely it will be made some exemption, exemption of each individual head of income. And sometimes if they are having loss of income in one head, the same head some other source of income is getting profit, then we have to be adjusted. That's the reason computation of income under each head is very important. Adjustment of losses, deduction of exemptions have to be taken. Next, we have clubbing of income of spouse and minor and children and somebody. So sometimes what generally the government people, what they are thinking is, if I am getting any illegal income or corrupted income or something, I will keep on with my wife name or my children name or somebody's name. So they wanted to make like this. Then definitely they doesn't have any other source of income. Definitely that all income will come into the first person total income only. So that as we are saying, deemed assessee. Deemed assessee is responsible for the spouse and minors and other people's total income. He has to pay tax. Of course, he was transferred intentionally sometimes. Those people doesn't have their individual source of income. Definitely the first person is taxable. Next, we have set off carry forward losses also have to be checked out. Set off have to be checked. Carry forward also have to be checked. Within the head, if you want to adjust, it can be come into the set off. Intra head, inter head. Then if you have still, if you are lost, for example, you doesn't have salary, you are doing some business, then you have a house property, you have capital gain, you have other sources, you are doing business. Then in the house property, one house is getting profit, another house is getting loss. You can adjust between these two. Finally, you can come out with what is the income from house property. Then, for example, business you have loss, but remaining all heads you have plus figure. Then all these figure plus figures you can adjust with the business loss on that particular year only. Then this particular loss again carry forwarding, because all setting up of other heads of income, still you have loss. That loss you can take into the several years. Next, future 1 or 2, 4 years, according to the provisions, you have to carry forward the loss. So here within the 1 year, within the heads you can set off, and you can also carry forward the losses. Then computation of gross total income. As everybody knows, gross total income is the very important step. If you are calculating GTI, you will be having deductions. If GTI is correct, deductions is correct. If deductions is correct, total income is correct. If total income is correct, taxable income tax is correct. Otherwise, everything will be wrong. So that is the reason what need to do is we have to be checked all the information that under the computation of gross total income, how to make and what how to manage, and everything have to be checked. So the deduction from the gross total income, we have section 80C to 80U, many sections are there. Under that sections, we have to check it out. What are the deductions? So deductions, we have separate chapter. We'll see in the next slides how deductions are getting. That is another tax planning. First tax planning is individual heads of income, maximum extension. You have to take exemptions. And second step, after individual heads of income, you can come to the gross total income, and gross total income you can get deduction of many things. Then you can come into the tax planning, you can get e-filing better. So the minimum tax, the government is also suggesting PPP, public and private participation, like that everybody has to get benefited. So assessee has to get benefited, government has to get benefited, and income tax system has to be get benefited. So in that situation, what are the planning we can make it, and how to make the minimum taxation system, we can see into the next slides. So before going to that, total income, after making the gross total income, because gross total income will be having some deductions. After that, step number 9 will have total income. Then application of rate of taxes, as we have discussed earlier, slab rate, flat rate, everything. Then if you have any rebates, section 87A now we are using. Earlier we have section 88, 89, some sections are there, section rebate and relief and something is there. So now the government and the tax system wanted to make a very clean, because many sections they want to, if you make many sections, many confusions, they want to streamline. So that many sections are now making streamline, like we have discussed new direct tax code. Like that, section 87A, we have some of the deductions. Earlier 88, 89 is abolished. 89 some sections are there, 88 is completely abolished. Now we have educational cess and secondary higher education cess, health cess. These are all the cess will be included after calculation of tax. And if you have already paid any TDS, that may be deducted. Advance tax, if you paid, that may be deducted. So finally, you will be getting either plus or minus. If it is plus, you have to pay. If it is minus, you will be getting refunds. Then we'll have look into the small gross total income a glance. Some of the people, particularly because in this group, I'm expecting many are teachers from the different colleges, and many are the tax students, and they are all there. So if you are an individual person, then individual person how to get exemption in a different heads of gross total income. We will look into that, because some people are following a general rule, only 1.5, 2.5 is the basic exemption, 1.5 is the savings. So 2.5 and 1.5, that's all. 4 lakhs is exempted. Not more than that. Somebody is fixing like this. Not like that. We'll have many things. So this many items, we have a lot of deductions. 80 CCD, this is very important, because some the commerce professors are following. Somebody is looking into this. Somebody is not looking. So this contribution to the NPS, National Pension Fund. So National Pension Fund, up to 10% of salary you can take. If your salary is 5 lakhs, 10% of that you can take. And 50,000 rupees. The maximum limit is 50,000 rupees. Every year you can deposit 50,000 rupees into the NPF. So 1.5 is the 80 CCC, triple C savings, and 50,000 is the additional figure. 2 lakhs you can deposit. Instead of paying tax, better to deposit in the National Pension Scheme, so that you will be getting additionally 50,000. This is generally people are not following. Then 80 CCF is there, notified long-term infrastructure bonds. So sometimes government is announcing ICICI bonds, SBI bonds, mutual funds, something. So in that specific long-term infrastructure bonds also, we can keep 20,000 rupees. Like that, many sections are there, individual HUF, 80 CCG, 80 DD, 80 DDB. 80 DDB is another important. Medical expenses on self-independent for a diseased specified rule. 11 DD. So this is a maximum deduction of 40,000, 60,000 for senior citizen, 80,000 every senior citizen. So this is now, it was revised in the assessment year, 1,25,000 now it is taken. So these are all the sections. If we look into that, we will be having a lot of deduction and tax planning. And we have 80E. 80E is one of the important section, because somebody is neglecting that. If you are taking educational loan, so for example, your child is studying engineering or maybe medicine. For 4 years, you can take the education loan. During 4 years, they will not impose any interest. So that loan you can take after 4 years, when that child is joined into the one job or somewhere. Then again 2 years will be given exemption. 4 plus 2, 6 years. Then after 6 years, after 4 years, they will start calculating interest. Then after 6 years, it will start EMI. So principal and interest amount can be deducted as EMI. You have to pay EMI after some time. So this is the exemption. Then whatever interest you are paying, that will be deducted here under section 80E. So this much of facility are there. We can look into that. If nowadays you can see your child joining into LKG also, they are asking 1 lakh, 2 lakhs donations in big schools. Generally, we can see it like that. By the time you can take loan and you can exempt under section 80. So this can be exempted from LKG to PG or PhD, anything like this. Next, we have 80G, as we know, 100%, 50% donations. 80GG is there, political parties, whatever the deductions is giving. There are a lot of other deductions are there. We are looking into the tax planning, how we can make the tax planning. Of course, the tax planning already discussed by Ravi sir. Just will glance into that. Then we'll immediately go to the e-filing. So if you want to make your tax planning, the earlier discussion, I will not repeat again. This will be, there are two important tax planning system here. Normal tax planning, ATC, as we have seen, 1,50,000, housing loan 2 lakhs. Generally, every salarized people can make these two. Salarized people, what is the tax planning? Only you can construct the house and you take the housing loan. That interest amount to 2 lakhs rupees can be deducted. This is normal tax planning anybody can do. And a little bit, if you come forward one step, you can go for critical tax planning. Under critical tax planning, we have to take tax rebate under section 87A, savings 80CCC, 80D, 80G, 80U, whatever the possibility we have to put into that, and we have to utilize all the sections. We'll look into this. Normal tax planning, how we can do best. If you have salary up to 6.5 lakhs per annum, you no need of paying single rupee as a tax. How to make that? Basic exemption 2.5 lakhs, as everybody knows. Savings section 80C, we can do 1.5 lakhs. This is automatically it will come, because sometimes the employer is deducting PF, Provident Fund, EPF. Earlier speaker already told EPF and contributory pension scheme, everything he told. So that all savings comes under ATC, National Savings Scheme, NSS, and fixed deposit, everything will come under ATC. So that is 1.5 lakhs, 4 lakhs. Then housing loan interest exemption under section 24B, as I've already mentioned in the previous slide, everybody can plan for construction of housing loan better. You will be getting exemption of another 2 lakhs. Then everybody nowadays, it is required. Section 80D health insurance, instead of paying income tax, better to go for health insurance. So health insurance, generally, it is 25,000, everybody knows. But if you have a senior citizens at your home, please include them, your parents, your grandparents, include them and make a single policy. So you will get 50,000 exemption. So like this, every year it is going to change. What is the exempted limit under section 80D health insurance? So if you make, instead of paying tax, better to go for construction of house, savings, and health insurance. So you can, minimum you can exempt to 6.5 lakhs. This is a normal tax planning anybody can do. So this is one way of tax planning. Without paying single NP, you can make 6.5 lakhs is exempted. Then let come to the step forward, critical tax planning. Just we will make our own how to minimize the taxation. Critical tax planning, 80CCD, contribution to NPF, as I'm already mentioned earlier, 50,000 additionally you have to deposit. 80CCF, already we have discussed long-term infrastructure bonds, 20,000. 80 DDB, if your parents is suffering with one specific diseases, some people nowadays, many seniors, if you take any senior people at home, definitely they will be having some, at least because of now the present conditions, environmental conditions, everybody getting any one disease, definitely you will be getting 140,000 rupees exemption. And if it is a serious, 1,25,000 rupees also is available according to the assessment years, it is going to change. And we have 80E, educational loan, we have discussed, 80G, 80GG, education loan, interest and donations. You can just make it a plan with making donation instead of paying taxation. So you can make it up to 1 lakh rupees. If you start with the educational institute, you can give donation to that institute and you will be getting exempted. And even your child fees, what you are paying at schools and colleges, they will be given 80G exemption. By the time also you will be getting 1 lakh rupees additionally exemption. And sometimes I've already mentioned the many people who are participated in this group are teachers are there, and they are all writing a books, royalty income of author, certain specified category of books, you will be getting up to 3 lakhs exemption. So what my suggestion is, if you are a researcher, if you are a teacher, if you are a student, if you are a scholar, definitely you start writing books. So you will be getting, of course, your total income is different, but you will be getting section 80 QQB royalty income up to 3 lakhs. And we have deduction in respect of royalty on patents, and even physics, chemistry people nowadays, even commerce management people also is getting royalty patents or something. Patent rights, if you are concepted, if you are finding one important concept which was registered as a patent rights, you can also do. E-commerce is a patent right, e-business is a patent right, e-payment is a patent right. Wallet payment is a patent right. You can prepare one important concept and you can claim section 80 RRB. So like this, you can just plan it and you can go for the critical tax planning up to 15 lakh 60,000. Generally, nowadays, assistant professors and degree lecturers, they're all getting 15 lakh 60,000. If you are making all these steps, definitely you are exempted from the tax. But only little bit, you have to concentrate on the research and education and medical expenses and all these things. This is one of the critical tax planning system. Let us go into the real picture, that is filing of ITR returns. So maybe this is a old slide, 2017-18. Now we have a filing system of ITR. Form 1 is there. Form 1 generally salarized people who are having single income, single house. If you have a single income, single house, single salary, definitely Form 1 is applicable, that you can take. If you have two houses, you have to go for filing Form 2. Two houses salary means multiple incomes of one head and another head is salary. Then you can use ITR Form 2. Like this, ITR Form 2, Form 3, when you are having business income, when you are having capital gains, when you are having different forms, we have to use according to the provisions of income tax. And filing of other ITRs. We have ITR 5, ITR 6, ITR 7. So when the person is having accompanying who are required with the declaration of return under కొంతమందికి ఏముంటుందంటే auditing ఉంటుంది. They need to finish off their books of accounts with auditing. Some people, they will be having income from AOP, income from company, income from HUF, income from dividend. Like this, if they are having different incomes, we need to participate with the different ITR forms. So that is very easy, because if you are open the income tax website, you can see what is ITR 1, 2, 3, 4, 5. Anybody can see. So whichever form is required, you can just go through and you can go into that. But our important issue is what is Form 26As and how to make e-filing system. Then come to the some of the important points which are very important for the e-filing system. So Form 26As, it is a credit statement which is maintained by the income tax department. Whenever, if any income generated, then income paying people, so that people, they are asking your PAN details. If you get salary, your employer will asking you PAN details. If you get some other remuneration, the people will ask you your PAN details. Like this, whenever PAN details are asked, you can expect that some of the TDS will be deducted from that source and the remaining amount will be paid to you. That TDS amount will remitted to the income tax department. So whatever this remitted, it will be showing under the form of 26As. How to get Form 26As online, I will show you that. So in that, if you go to the online account of your income tax through your PAN online account, you can get through the 26As that can be downloaded, and you can see how the 26As will come out. So this is the heart of the form which you are going to filing of income tax. Form 26As, what are the details already credited, tax credited in the income tax department have to be verified. Sometimes we doesn't know, because sometimes we are going somewhere and we are getting some income, we are going some evaluation, we are going for some viva, we are going to for some other places, some other source of income, professional income, consultant income, business income, something we are, when we are getting, sometimes maybe we are forgetting that how much tax is already deducted, we don't know. But at the year ending, when you are going for e-filing, then you have to, it is a mandate. When you are onlinely you are submitting or manually you are submitting, income tax people are cautioning that you have to check Form 26As, which is already there in the online e-filing system. So you have to go to the income tax department website and you can see what is the income tax already deducted as TDS and how much it was credited to my account. You have to check it out accordingly. You have to calculate your income and you have to pay income tax. So that is the reason 26As is very important. It has to be downloaded from the online sources. And this is, we will see what is trace and all these things and how to get, after filling up our, when you are getting to your account, online account, login, then you can search into that and you can get a 26As. In the 26As, progress also you can check it. For example, now we are there in the 2021 accounting year. 21 is not yet finished. So 21 March it will be closed financial year. But before that, anytime you can ask what is the progress of tax credit in our account. You can check it out using 26As. As soon as your tax is deducted, it will goes into the 26As form automatically. That program already made by income tax department. Progress of your tax also you can check during the financial year, and after completing financial year in the assessment year also you can check it what is the form 26As linked with the PAN. Then we have some for opening that login and checking into. I will show you practically then how to get to 26As. Then form 26As details of tax deducted at your income and who are the deductor, and details of tax collected and collectors, and advance tax paid by the taxpayer, self assessment tax payment. మీరే క్యాలిక్యులేట్ చేసుకున్నారు. You are getting some tax additionally. Then you are paying your own self assessment tax. That also is available in that. TDS available, everything is available. The regular assessment tax deposited by the taxpayer also you can see with the PAN holders. You can check it out, progress taxation. And details of refund received by the assessed during that particular financial year also you can check it out. Details of high value transaction in respect of shares, mutual funds, exempted income, how much you are received out of that, how much exempted, how much it is taxed, how much tax deducted, everything will be showing in form 26As. Next, other important issues. And form 16, everybody knows, salarized person, they will be getting from the employer whatever TDS collected from the salary income. Every time he has to credit to the income tax department, and he has to issue out of your 10 lakh salary. We have already deducted 1 lakh. This 1 lakh is per month this much. Then for overall 1 year, 1 lakh is already deducted. Out of that, whatever the details you are submitted to us, this is your income, this is your tax, this is already TDS corrected, and the remaining amount you may get refund or you may get tax payable. That all the details will be available under form 16. Form 16 will be issued by the employer to the employee. Employee is a owner who is appointing employee. Then he has to be issued form 16 to the employee. Then these two forms are very important. If you have these two forms and online account, you can easily make the e-filing system. And we have section form 16A, that is TDS collected. Disturbances. So form 16A lo whatever TDS deducted by the other source of income. Generally, we have fixed deposits and other professional income. If anything is deposited, not regular salary income, so that income also available under section 16A. That 16A also will be given details of tax deducted already in the previous transactions. These are all comes under section 16A. 16 will have to be checked before going to e-filing the system. So when we are going to the e-filing system, so return how to make gradually, income tax department is hoping to bring all the returns online in any of the following cases. The income tax department has made it mandatory to e-file the income tax return. So ఇప్పుడు మనకు కోవిడ్ దృష్టిలో కూడా this is a best issue because we don't touch the physical forms directly online. You can make e-filing system. That's the reason. Even if you doesn't have 2.5 lakhs, also you can make filing system 1 lakh, 2 lakhs, whatever it is there. Nil returns also you can make filing into the e-filing system. If you want to get a refund, then definitely e-filing can be helpful. Then your taxable income is more than 5 lakhs, it's a compulsory. Then ITR 3, 4, 5, 6, 7 have to be mandatory for e-filing. Of course, 1, 2 is not included, but now 1, 2 also the people, 99% people are looking into e-filing because of COVID, because of benefits, because of refunds, early returns, early refunds, immediate refunds, everything. And the paper return can only be filed by those who are above 80 years of age or by any individual or a HUF whose income does not exceed 5 lakhs and who not claimed any refund in the return of income. So this is earlier practices, but the people are now interested to make e-filing everybody. And the income tax, if you come to the website, we have www.incometaxindia.efiling.gov.in. This is the website how we can go for e-filing system. And online services, tin.ego.gov is government, e-government. -nsdl.com. This is another important, but first website is authentic website. We can go through e-filing through that. That is better. And what are the steps for e-filing? The registration, register yourself first, then choose how you went to e-filing, because there are methods out there. If you want to offline, online, you can go like that. Select the request forms, ITR 1, 2, 3, what are the forms. If you want, you can go like this. And we have step 4, keep the documents ready. As I'm already mentioned, form 2016 and form 26AS. These two forms are essential to make calculation of income tax. If you earn more than 50 lakhs from this year, you will have to fill additional column. And if any assets, liabilities, you have to be disclose the value of your assets and liabilities and everything. Generally, these type of returns, generally, there people are going for auditing also. So anyway, after completing all these things, you have to verify your ITR. So income tax return, whether you are done yourself and whether you are authorizing or not. Through online also you can authorize with Aadhaar based, or your SB account, online account based, you can authorize, or you can take the printout and put the signature and you can send it to the income tax department. That is called verification of ITR 5. So this is one authentication which we are saying to the income tax department, all the particulars what I filled is correct. Then once you are giving authorization, then the people will send you whether your particulars are good, your particulars are genuine, or everything will be verified, and they will be sending assessment order. This is the general practice. And offline, we can also do the e-filing. Offline, you can download the Excel sheet. Then in the Excel sheet, there will be one XML file will be downloaded. In that, you can just filling up all the hyperlink columns. అంటే ఒక సెల్ నుంచి ఇంకో సెల్కి హైపర్ లింక్ ఉంటుంది. వన్స్ యూ ఆర్ పుట్టింగ్ ఫిగర్, దెన్ ఇట్ విల్ గోస్ డైరెక్ట్లీ టు క్యాలిక్యులేషన్. ఆటోమేటికల్ tax calculation will come out in offline also. So you can download in that is one another offline system. Without internet, you can download Excel and you can just after from internet, if you downloaded the Excel form, without internet also you can fill up all Excel form details. And finally, as soon as you are getting satisfied with your tax liability, you can that XML file you can store into your desktop and you can send it to the upload into the income tax website. So that is one important issue. And online also you can do. Nowadays 90%, 80% people are following online is very easy. Instead of downloading everything, although some particulars are exist in the online system, you can prepare online and you can submit it. So for that, after submitting this verification, within 120 days, you have to submit the whatever authentication is there earlier. But now we have online verification system is there. That 120 days, no need of waiting. You can send it immediately. Within 1 month, you will get refunds. You will be assessed everything. And that is the best practices now. So these are all the forms. Keep ready when you are going for filing your income tax returns. And this is another advice, whatever filing you are doing manually or online, anything, it should keep 8 years. 8 number is very important in the income tax. The income tax people are every time looking your all the particulars, whether you are keeping all the particulars for 8 years or not, they will look into that. Then what is exactly how to make e-filing system? Let's come to this. First, log in your income tax credential used with PAN. So we'll practice that. Our website, maybe it is some slides are there. We'll look into that. What are the requirements, credential are required. You have to use that and you can get into the registered. After register, you can get into the login. After login, you can go to submit all your income tax e-filing system. So these are all the different steps. Dashboard lo click cheyali. Click on tab e-filing, select option, prepare and submit online ITR. Write your PAN number and select ITR form 1 and assessment year. Fill one by one personal information like income details, tax paid verification details. These are all details have to be verified. And fill income particulars, fill TDS particulars, fill bank details. These 5, 6, 7 is very important. Income particulars, TDS particulars, bank details have to be submitted. Then at the dashboard, click e-file return and form and download ITR file. This is all earlier system. So ITR 5 you have to be downloaded. Then after downloading that, you have to be stored. Next, let us come to the website. In the website, how to make, we have to check one by one. So this is the real-time practice. You have to go to the Google Forms and you can type website address here, http://income tax India e-filing.gov India in. So if you type this directly, you will get this website. So accordingly, this site, we will look into the login page. In the login page, how to do, we have to check. So first, if you want to get into the login, because you are already registered, registration will look into after. So you have to type your PAN number. Here ANIPRT464C is a PAN number. And whatever earlier you registered, accordingly password have to be typed. The registration will look into the another slide. So date of birth, only this PAN number, your already created password and date of birth have to be typed. Then capturing, sometime capture codes will be given. According to capture codes, we have to check into that. Then after typing this, you have to get into the next column. So once you are logging into that, you have to make somebody making disturbance here. Right. So here, dashboard, my account, e-filing, complaints, download, profile setting, my request list, work list, help desk, everything. So that's the reason you have to check whatever the important things we require to get it. So first, if you go to the dashboard, you will get it to two important information. So what is that? One is already filed returns, you can check it out. The second one is you have to check into the earlier forms and e-filing preparation now. The second one is we can go to my accounts. In the e-filing, you can go and you can get downloaded section form 26AS. As I am already mentioned earlier, form 26AS keep ready, and form 16 also you should keep ready. So that is the reason what we are doing is first form 16 manually you are getting from your employer, but form 26AS you can download from this. So you keep ready all do these two things and you can go for the submission of income tax return. So income tax return, when we are going for submission, here you have to the PAN number already written, your PAN number, and select ITR form, whether ITR 1, 2, 3, 4, and assessment you have to select, and you can upload file whatever offline you have done, that you can submit file. Then after submitting offline file, that is one way we can submit file, whatever the Excel file what we have downloaded. So otherwise, you can come to the online submission. This is online submission. You prepare online and submit all the particulars online. So fill one by one personal information, income details and tax details and tax paid verification deduction details. Do not forget to save the data frequently. After filling all the details, submit the income tax return. Then here we can look first instruction, personal information, income details. It is appearing here, tax paid and verification. Then if you look into that one by one, if you come into the particulars, it will be asking PAN number. So this PAN number automatically it will be appearing here, and male or female, the date of birth. So these are all some fields already by default it will come. So you can just verify, because if you are already submitted earlier, these are all the particulars by default it will appear. If any particulars are wrong here, you can make it correction here also. This is all personal information. Let us come to income details. Here, first, what is your income? They will ask you one by one, step by step, your salary income, a house property income, and all other source income. If you are filling all these things, you can come to the next, that is section 80C, 80CC, 80CCD, 80D, whatever incomes exempted under this, we can fill up one by one. So this is income details slide. Then we can come to next. These are all some other deductions. As I'm already mentioned, rebate section 87A, and any other deductions, any other cess, any other refunds, anything is there. So that all will take into here. Then after making all these details, we can go to the next TDS, how it was deducted from our resource. You have to check here. In the form 16, the TDS, whatever deducted earlier, it will be given in this. By default, it will come. But you can also check what is the TAN number of tax deductor. So if you are working in one Usmani University or somewhere, the Usmani University will be having TAN number. So because of their TAN number, they are linking with PAN and TAN, they are remitting all the taxes. So the TAN number by default it will come. If it is not coming, you have to type it here. And who is the deductor? Usmani University. This is the number, or whoever is the employer, you have to type here. And how much amount you are making as TDS, how much you are claiming TDS. Like this, you have to fill up. And if you are working 2-3 organizations, you can add here plus symbol, add symbol is there. You can press this and you can go for second field and you can enter the another TDS field. Like that plus figure is there, delete. You can, if unnecessarily, if you are created something, you can also delete. Add and delete is there. Like this, 16 form 16 details here you can mention. Form 16A details, other source income like bank interest or anything is there. You can also mention here. Then like this, if you have self-assessment, if anything is done, this third place you can make it self-assessment particulars. Then let's come to the another important, that is whether tax paid excess or whether we are eligible to get refund or whether we are getting tax payable. That can be filled up here. So that can be whenever we are filling up here. So you can observe whether your tax is more or whether tax liability is more. Here it will be appears whether it is refund or payable. If it is payable, you can go to the payable account and you can pay that amount online also. If it is refunded, you silently keep like that. So the assessmenting officer online, they will verify. Central processing office in Bangalore, as soon as you are submitting this online e-filing, the Bangalore people will verify and they will be throughout India. Bangalore is the center for central processing of income tax department. They will verify and they will send back refund within the 1 month or 2 months. Generally, if you are sending by online verification, 1 month. If you are sending by physical verification, 2 months. It will take 2 months. So like that, refunds will get it in your bank account directly. So because of that reason, you have to mention here bank details. So IFSC code, name of the bank, then other details and how many accounts are there, you can mention. But out of 3-4 accounts, you can select one account is important when you are going for the refunds or any payments or anything like this. And here place of income tax return and your name will appear, and under this your father name will appear, and whether you are doing yourself or behalf of you somebody is doing, or tax practitioners are doing, tax return preparer, TRP, name of the TRP, tax return preparers are doing. These details have to be filled up and you have to submit button here. Once you submit, so this form will goes to the income tax department. If any problems are there, you can also resubmit the income tax return. You can refiling the income tax return. Like that, you have first submission, section 132, second submission 135, then 142, 149. We have sections are there. Revised return also you can submit 2 times. Like this, we have provisions to make corrections. So for example, if you do any mistakes, you can do it again. So the e-filing system that all available, and even manual system also that is available. Then once you submitted, you can go back and check in the dashboard. In the dashboard, the returns what you are there, you just click on e-filing returns. Then this website will come. This appearance will come. Under that, you can see acknowledgement number here 88428025013115. Some number will be generated. According to that, you can just click on. You will get acknowledgement number. This is every assessment here. It will appear. For example, last 8 years you are making 8 years acknowledgement will appear there. You can download and you can keep ready as a physical copy. And downloading, how it will be going to download. So once if you are clicking that red color 8842, if you click here, then you will get it this download status. So you just click acknowledgement ITR 5. You can download that and you can keep again with us. Then once it is downloaded, it will ask you your password. Generally, put your password with the date of birth in lowercase. That's all. You will get it downloaded. You can see that how it will be appeared. And these are all some of the penalties for non-filing of income tax returns. We can understand what is the need and importance of filing of income tax return. If you are not filing income tax return, penalty for non-filing of income tax returns are also very serious nowadays. Earlier, these rates are there in 2017 and 18. Now it was revised according to the assessment year. They are making, instead of 5,000, it will make 10,000. Instead of 10,000, they will make 20,000. It's all depending on year to year. So that is the reason under section 271F, the assessing officer may levy a penalty of 5,000 rupees when you have not filed your returns applicable for that particular assessment year. So that assessment year, accounting year, if you are not filled up and if you are not submitted, then these problems are coming up. A penalty of 5,000 rupees is applicable if return of is not filled.
Sir, unmute yourself, sir.
Yeah, is it okay now?
Okay, sir, fine.
Yeah. So this is all penalty figures, 5,000 rupees within the due date if you are not filing. So penalty of 10,000 is applicable for the return of that particular assessment if you are not filing of 31st March 2019. This is all old last years. Then this year 2020-21 we have to match with that. If you have missed the above due dates, to file your return, you can still file before 31st of December by paying a fee of 5,000 rupees. If you are filing after 31st December 2018 also, you will have to pay another 10,000 rupees also. Like this, we have fine system is there. Some people, for example, you are all newly income generating people. Earlier, last 3 years, you doesn't have any income. Now you are joining into one job. You want to make it last 3 years. If you have nil returns, no fine, nothing like this. Belated returns, you can file it. Then, but if you are income earning people, if you have more than basic exemption limits, then if you want to submit, definitely you have to pay all these fines. Automatically, it will come in your tax liability. Fine will be included. So this is all some filing system and penalties and something. If you have any doubts, you can raise and we'll discuss. I think hope because one time it is not possible to understand. Sometimes you have to practice your own. And I'll show you some Form 26AS. This is the Form 26AS. You can see. I think it is shown, no? Venkatesh and other people, you can respond. Form
Yes, sir.
26. Form 26 is
Hello?
visible, no?
Hello?
Thank you, English.
Yeah. Annual tax statement under section
No, sir,
203.
it is not visible, sir. It is not visible, sir.
Only thank you for coming, sir. And
Okay, we are getting only thank you, sir.
Yeah.
Thank
Now
you.
now you can see now.
Yes, sir.
Form 26 says annual tax statement under section 203. So if you go into the income tax, this is the website. I think I'll show you again. I need to share again. I'll go to the website.
Sir, with your permission, can I add one point, sir?
Yeah, please.
Dear participants, please check your login site because some fake sites is also having same features, same designing. While logging in your site, please just check .in, last with government .in. That is the indication.
I think this income tax website is visible to everybody, no?
Yes, sir.
Yeah, just you can see this website, income tax India e-filing.gov.in. So if you type this website, it will come like this. Then here we have options: register yourself, log in here, reset here. Then register yourself have to be checked first. In this registration, you have to select individual, HUF, or external agency, chartered accountant, tax deductor and collector, third party software utility developers. Like this, you can select. Generally, we are all individuals. You select individual, continue. Then in this, Your PAN details, surname, middle name, first name, date of birth, whenever you applied for PAN, the particulars how you are submitting for the PAN, all these particulars have to be submit again here. So this is one of the important registration system. If you make all particulars what you have given in the PAN registration, so that all particulars, if you press here, then the registration process will be very simple. You can get it registered. So that is one. Once your registration is over, then it will send you one email PIN number, phone PIN number. They will send you two pins. One is email, whatever you mentioned. Another one is cell phone PIN. Two pins they will send. If you use the two pins and log in again, so you will get into the login into this. Very simple. Only important information is whatever PAN details earlier you have submitted, same details have to be submitted here. If you doesn't know PAN details, because long back, 5 years, 10 years back, you are submitted, you doesn't require, you doesn't remember anything. You go for here. Without going to login, you just look into the home page, you verify your PAN details. Here it is there. So you can just check it out, your PAN details. You type PAN number, everybody having, your full name, everybody having, date of birth, you can understand, and you may be remembered, and your status, everything is there, capture. This capture code you have to type. Then your PAN details will appear. However, PAN details are appear, that all details you have to use in the login. Whenever you want to get it, login details, you just go to here, register yourself. Under register yourself, you can put all PAN details. So you can get created account using with your phone number, using with your email. You please remember these two, keep ready. As soon as this registration is asking PIN number, you have to enter from your mail ID, from your phone number, SMS. So these two, if you are typing for registration, it will be registered. Then you can go for login here. So once you are got registered, then all previous details automatically it will come, because your PAN, through PAN you are coming out. Earlier, whatever history in the PAN, your account, so all the details will be updated in this software. Automatically it will be appears. So that is the benefit. You can check every time how tax returns are filing, what is the acknowledgement, everything. Okay. So of course I am making a lot of issues, but anyway, I'm just giving time for, I think Ravi sir, up to what time we can do, sir?
6:40. 6:40. Actually,
yeah.
6:40.
6:30.
Yeah.
Because early
No
we
problem.
started, no? 6:30,
Yes,
6:40.
yes.
Yeah. So here, the income tax
Right.
return, sometimes when we are looking into income tax e-filing and downloading offline, online, sometimes it shows sometimes very easy, but while practicing, lot of doubts will create. So my thought is, you better to ask me questions. We'll make it experiments on this online system, so that we'll get in touch, best practice. Because sorry.
They will post in chat box, sir. If they have any queries, they will post
Definitely.
in
Chat box kani, direct questions, or if you look into this and you can ask me anything. So e-filing system lo మనం చేసుకోవచ్చు ఏదైనా కూడా. You just have a look on that. I'm requesting all the participants to raise the questions.
Sir, one small question, sir. Hello. Hello, sir.
Yeah, you please introduce yourself and you.
Please chat box, sir. Please use chat box. Please use chat box.
Sir? Sir? Am I audible?
Yeah. Ramesh sir.
One query came from Ritika, sir. After how to get PAN card renewal? How can I get my PAN card renewal?
Yeah. PAN card renewal andi.
Yes, sir.
Yeah. It's very simple అండి. NSDL వెబ్సైట్ ఉంది. ఇంతమందికి యూనిట్ ట్రస్ట్ ఆఫ్ ఇండియా వాళ్ళు డీల్ చేసేవాళ్ళు. కొద్దిగా డిస్టర్బెన్స్ వస్తుందండి. మీరు క్వశ్చన్ అడిగిన తర్వాత మ్యూట్ చేస్తే బెటర్. ప్లీజ్ మేక్ ఇట్ మ్యూట్. మీరు మ్యూట్ చేయగలిగితే ఈజీగా చెప్పగలుగుతాం. ప్లీజ్ మేక్ ఇట్ మ్యూట్. యా, ఇట్స్ గుడ్. సో NSDL వెబ్సైట్ ఉంటుందండి. ఆన్లైన్ ద్వారా మనం ఎవ్రీ టైమ్ వీ కెన్ మేక్ ఇట్ వెరీ క్లియర్లీ. వీ కెన్ మేక్ దట్ very simply. We can do that.
Good evening, sir.
Yeah, good evening.
This is Shanta from AV College.
Okay.
Just now, sir asked about the renewal of the PAN card.
Okay.
Is it mandatory just like the Aadhaar card, sir?
Yeah, it's a mandatory, madam.
Because I took it long back ago.
Okay.
Before it, 15 years ago, I took the PAN card.
Yeah.
Is it compulsory to update the PAN card?
No, actually, you will be getting a message from the NSDL. PAN organize చేసే వాళ్ళ దగ్గర నుంచి మీకు మెసేజ్ వస్తుంది. As soon as you are getting message, you should go for renewal. Otherwise, it's not required.
Okay, sir. One more question.
Yeah.
When we will get the TDS amount, sir, if we file the returns?
As I've already mentioned, if your verification is done through online, అంటే మీరు e-verification చేశారనుకోండి, if you done e-verification, then within 30 days, you will get back. If you are not done e-verification, you are sending a downloaded statement, then definitely it will take time.
Okay, sir.
2 months time it will takes.
2 months.
Yeah.
Thank you, sir. Thanks a lot.
Hello, sir.
Yeah, madam.
Good evening, sir. I am Kanakdurga.
Good evening, madam.
Sir, వినిపిస్తుందా sir మీకు?
Yeah, it's very clear, madam. You can ask.
Sir, you said that continuously for about 8 years we are supposed to file the returns, IT returns.
Exactly.
Suppose if there is any break due to any reason, what is the alternate to continue it, sir?
See, if you have a genuine reason that first 4 years you are submitted income tax return.
Okay.
Then after that, it is not required because you are not working in that organization. You doesn't have any income. Something has happened. You are not able to submit. It is not required to submit, of course.
Okay.
Then you can continue after 1 or 2 years also you can submit. But whatever not submitted, including last 4 years submitted, after that, before 4 years, 2 years gap, another that 4 years. So preceding that 4 years. 4 plus 2, which is not filed, plus 4. So total 10 years. Out of this 10 years, leave it last 2 years. So 6 plus 2. 6 years you are already filed. 2 years is not filed. This record should be with you. So that whenever they are asking scrutiny assessment, you have to show all your details. Why you are not submitted, they will ask you question. And you have to show that justification that the last 2 years I have not worked or something has happened. I doesn't get any income or something. You can show the justification and you can give that information to the income tax authorities. You will be exempted.
Sir, start your video, sir. Your video is muted.
Yeah. Anybody?
Sir, one more question, sir.
Yeah, please.
Suppose I am filing the first time this year only I filed my returns, sir. Can I file for the previous years also?
Yeah, definitely, madam.
How many years, sir?
That we have already discussed.
How
Generally, income tax department, if those who are not submitted earlier, last 3 years, they will be given the permission for last 3 years. You are able to submit your previous returns. Okay?
Only for 3 years, sir?
3 years generally, but sometimes income tax department also will be given scheme. All backlog candidates can submit for 5 years, 6 years, like this. Some schemes also will be given. Like now TRS government is given for regularization of land. Like that, sometimes we will get a permission from the income tax department that last 4-5 years also you can submit. That scheme will be implemented by the income tax department.
Okay, sir. Thanks a lot, sir.
But general rule is 3 years. Yeah.
Okay, general is 3 years. Thank you, sir.
Yeah.
Sir, another question is there in the chat box, sir. Can we edit the details after submitting? That is asked by Dr. Rajashekar Deti.
Yeah. So generally what I'm already mentioned is when you are submitting online, you cannot retrieve it. It is already submitted. It is gone to the income tax department. So if you want to modify anything, you have to submit again section 142, revised return. You have to fill up another new return. You have to submit again. So when you are submitting second return, then it will be asking, what is your first return acknowledgement number? You have to fill up that number so that it will be recorded first return already sent, and this is the second return under section 142. So 132, 135, 142, 149. These are all options available. Accordingly, you can submit.
Thank you, sir. Thank you very much.
Yeah.
Hello, sir.
Yeah.
So our employer is submitting form 16A, and my total income is around 4 lakhs per annum, sir.
Okay.
So, but I didn't submit any form directly to the income tax authority.
Okay.
So,
You are not filing.
I'm not filing, sir.
Okay.
Do I pay any penalty if I want to pay file for last 3 years?
There are two things.
Because sir, one more thing, sir, because my gross total income is more than that limit, minimum limit. But if I deduct all the things, then that is under the limit. That is below 2,50,000. That is the issue.
Of course.
Thank you.
But according to the rule, whether you are taxable, you may not be more than 2.5 lakhs. Sometimes you may be more than 2.5 lakhs. Anything, because you are exceeding 2.5 lakhs, after that you are claiming exemptions. Anything, you will be the nil return you have to submit.
Sir, unmute yourself, sir. Sir.
Acha, ఇది automatic గా mute అవుతుందా? Right. So here, whether you are exceeding 2.5 lakhs, whether you are taking all exemptions, ATC exemptions, or maybe some exemptions, you are investing somewhere in savings or something, whatever it is, but you are exceeding 2.5 lakhs is first criteria. Nil return you have to submit. Of course, you are exceeding, but all are exempted. You have to show that. So that is called nil returns. Nil returns have to be submitted. It is compulsory. So in practice, I am telling, because I worked in a chartered accountant firm, I have a little bit experience with that practice. So generally what the people are doing, if you are not expecting in future more income, it is not liable for paying more taxes, better to leave it, because nobody will not ask you. But if you are expecting to make a lot of income in the future and you are going to earn something and you are have to be paid some tax in the future, definitely you have to file. Better practice. Because if you are not filing, they will ask you, as I'm already mentioned, 8 years. Sometimes if it is a serious scrutiny, they will ask you from the inception. Then they will be calculating total tax with fine, with interest, with penalty. Many issues are coming out. Better you start at least now. Last 3 years, if you make, then it will be regularized. Whatever the earlier is over, you leave it that. At least last 3 years, you can start making filing. It will be the good practice.
Will be there any penalty, sir, for that last 3 years?
If already you are mentioned that you doesn't have any tax liability. If you doesn't have any tax liability, no penalty. But if anything comes as tax payable or something tax liability, you should face the penalty also.
Thank you, sir.
Yeah.
Sir, good evening, sir.
Good evening.
Sir, this is Karuna from Kartali, sir.
Tell me,
sir, madam. Actually, I have one doubt, sir.
Madam.
Sir, we have tax consultancy in our college.
Okay.
And I do look after the tax matters, sir.
Good.
I have one problem trying to solve for these years, but I'm not getting solved. And I'm also raising query with the income tax departments of CPC cell.
Okay.
But they are also asked us to contact chartered accountants.
Okay.
The problem is this, sir. Actually, this e-filing system has been introduced in 2012.
Yes.
Before that, used to be like transfer our income tax amount to appellate authorities.
Yes.
But they didn't transfer that amount to e-filing system. That is being showing as till date demand.
Demand notice is still it is pending.
Yeah. If any refund is there, it has been adjusting with that.
Okay.
How to do this, sir?
Okay. So just a minute, madam. I will clarify.
Sir, one thing as for my knowledge, there is a grievance is there online portal.
Yeah,
actually
you can
same problem I faced when manual system is there and 2011-12, and I approached so many times to our Hyderabad ward income tax department. They have not anything. Frequently every year I'm getting notices from them, but once it is e-filing system has introduced, I applied the same grievance through grievance portal in the online system. So automatically it is resolved within 1-2 months. It was resolved. Better you can upload in the same grievance in the e-filing, madam. Karna madam.
Sir, actually the problem at the institution level has been solved for demand notice of 43 lakhs, sir.
Okay.
It has been resolved at the institution level, but when coming to the individual level of the faculty, it's not getting resolved, sir. Even though we are approaching the same procedure, what you told just now, sir.
Madam, this is a big issue actually.
Okay.
Chartered
Yes, sir.
accountants have to deal this because a big
That's what,
amount
sir.
and big people, you are doing an excellent professional skill, everything. But what I'm saying is because income tax people and the central processing unit also, some of the new people are appointing, they doesn't know what the earlier procedure and how it will be resolved, everything. That's the reason generally they are suggesting to approach chartered accountants, because they are all practitioners, they are long back, they are doing. But in the department, maybe new people are appointing, sometimes they are getting confused. And because old system, if you ask, no, definitely there is a big confusion. And of course, they need to resolve something. But generally, what they are asking is you just go to advocate like that, chartered accountant, you can go and you can ask them, so that you will be resolving many problems like this.
Yes,
But
sir.
the thing
They
is,
suggested that only, sir.
yeah, this particular issue is we have to refer many books and many practices, many ready reckoners. That year what is the provision, and next year what happened, how long we can resolve this problem, why it was not resolved. All these things have to be verified, and what are the steps to be taken to resolve. These are all, many things are there, madam. So that's the reason.
Sir, sorry to say this, sir, but even till date, sir, some of my colleagues have consulted chartered accountants. In spite of that, the problem is not being resolved, sir. Still, the refund amount has been adjusted. So they are afraid of paying advanced TDS.
Exactly, madam.
That is a problem, sir.
Yeah. But we can resolve that. It is there. You can just approach the senior.
But at the institution level, sir, we approached Aikar Bhavan, and that problem has been resolved, sir.
Acha, good. Acha, okay.
Okay, sir. Thank you, sir.
But individuals are not resolved, huh?
Yeah, individual faculties problem is not resolved, sir.
Acha, but still it is showing.
Yeah, still it's showing. But at the institution level, it's resolved, and I'm trying to give them that clarification also.
Okay.
Madam, did you upload the same thing in the grievance? Did you upload the same thing?
Yes, sir. Yes, sir.
Okay.
Even then, in spite of that.
Yeah, normally in online grievances, they're resolving immediately. But now I don't know what happened in your case specifically.
Yeah, Ravi sir is said correctly, madam, because we have a portal system. Whenever whatever problem is there, online you can put it. But sometimes, as we have already mentioned, 2012 onwards only, there are some online records are available. They can verify online only. They don't go for physical verification, because they are doing central processing somewhere in Bangalore. But these physical documents, your files are available here in Hyderabad. They won't come to Hyderabad. They won't ask any details from Hyderabad. So that is a problem sometimes. Online is different verification and manual is different verification.
That's what, sir.
Yeah. Exactly. So that we have to understand sometimes.
Yes, sir.
Yeah, good.
Right, sir. Thank you, sir.
You are a good practitioner, madam, than me, because of course I am filing for
whatever I have little knowledge in that, I'll try to help my colleagues, sir.
Okay, that's good. Actually, I am also doing like that, because I worked in chartered accountant 5 years.
Okay, sir.
Then using that knowledge, I'm making with all my friends like Ravi and other senior colleagues. We are taking all the information, and I'm helping for 40 professors in the university.
Okay, sir. Right, sir. Good practice. Actually, when I was working at Gajwell, sir, I started this tax consultancy as a good practice, sir. As a part of IQAC.
Excellent.
Sir, thank you, sir.
Because every commerce teacher, I'm asking, every commerce teacher should be resource person for others to make, at least you can advise them to make filing at least.
Yes, sir. Even, sir, now also, even I am working presently at Kukatpalli, sir. I'll try to resolve my colleagues' problems when they miss some credits in their 26 years.
Acha.
So I'll try to locate them, and so what problem exactly has happened, I'll try to contact with the chartered accountant and try to do that, sir.
Excellent. You just like me, you are doing better service.
It's not like
we'll
that.
We'll go
sir.
for next. Yeah, next.
Thank you, sir.
Venkatesh, upload a feedback and attendance for the third session. If any queries is there, otherwise can close the session.
Sir, already uploaded, sir. Already uploaded. Feedback and session 3 attendance.
Yeah, Ravi sir, are you there?
Yes, sir. I'm very much here.
Yeah, please go the formalities.
Thank you very much, sir.
Yeah.
Sir, just a minute.
Go ahead, sir.
Thank you very much, sir. Dr. Indrakanti Shekhar garu. In his presentation, he has dealt with various deductions ranging from 80C to section 80C to 80U, and the tax planning issues we have dealt with, sir. and filing and Form 26A as a practical knowledge you have given to the participants, and you have also dealt with penalties for not filing. And these are the topics that you have thrown light upon, and we are very much thankful to you, sir. And your practical experience you have put into the usage in this workshop, sir, national level workshop, for the act of which we are very much grateful to you, sir. And up to now, 3 days of this national level workshop is over, sir. On the first day, fiscal policy and Indian taxation system, tax reforms and research areas in taxation. These two topics were dealt by Professor M. Usha Garu. And on the first day, in the last session, terminology used in taxation was dealt by Professor V. Usha Kiran Madam. And on the second day of this 7 days workshop, heads of income topic was dealt by Dr. O. Bhavani Madam. And set off and carry forward of losses and aggregation of income was dealt by Dr. B. Sandhyarani Madam. And ETDS and advance payment of tax topic was dealt by Dr. A. Patrick Garu. And today, that is the third day, tax planning was dealt by Dr. Ravikumar Jasti. And investment avenues and tax consideration topic was dealt by D. And last Form 26 AS and e-filing of income tax was dealt by Dr. I. Shekhar Garu. With this, we have covered various issues relating to income tax. And from tomorrow onwards, that is 4th day onwards, we will switch over to GST. And I am very much thankful to Dr. Ravikumar Jasti Garu and Dr. B. Sandhyarani Madam for giving me this opportunity today. And I thank all the participants for your patient listening. And I hope you are very much knowledgeable now on various issues relating to income tax. And thank you very much.
Yeah, thank you, Ramesh. Thank you, Shekhar sir. Thank you very much for presentation.
Thank you, sir. Thank you, Ravi sir. Thank you, one and all, for patient listening.
Yeah,
thank you, one and all.
Thank you, Shekhar. So, Venkatesh, I think you have done the feedback link and attendance sheet.
Yes, sir.
Okay.
Shekhar
So,
sir,
all the
thank you,
participants.
sir.
Thank you, thank you, Venkatesh. Thank you very much. The successful
you,
program.
Sir. Thank you, sir.
And many people, participants are good.
Yeah, sir. We thank to all the participants.
Yeah, excellent, sir. All ippudu varaku patient ga undi. They are all very enthusiastic to learn, and they are they are making a lot of valuation for the 7 days program.
Yes, there is a value for our efforts also, because we are keeping alive. So
still 100 people are continuing, sir.
All the participants you have done 3 days you have successfully completed, and income tax part is over today, and tomorrow we are going to start the GST. Mostly the GST sessions are shared by experienced by the chartered accountants, and I expect the same enthusiasm and your interest for the next 4 days. Some of the people are asking about that they're not able to open the links, and other some people they are not, because of internet problems and all those things are there. Don't worry about that. If you have attended all the sessions, you have missed only 1 or 2 because of internet and all those things. So anyhow, you are taking the screenshots of your attendance and all those things. Again, you will remind me on Sunday. Whoever missing it, maybe 1 or 2 sessions, definitely will provide the links for the 2 sessions, whatever you missed 1 or 2 sessions. That is no problem, because we are taking the screenshots and your attendance is with us. And suppose if you really missed, you already listen the class and you are not able to submit the attendance link, again we will send you. Don't worry. Again, just remind me on Sunday morning, and we will provide the links to you. Don't worry. Thank you once again. Good night to you all. Venkatesh, did you get all the?
Thank you. Can I close it, sir? Yeah, already given feedback 15 minutes before.
Okay.
To ending the session.
You received all received, or how many received? Just to check.
Just 1 second, sir. I'll give complete information. Okay, more than 100 responses we got.
Yeah. Otherwise, we wait for another 2-3 minutes and.
Definitely, sir.
Yeah.
Okay, sir.
Can I leave, Venkatesh?
Okay, sir.
Right. Thank you. Thank you again. Tomorrow, again, your Zoom link will be provided to you tomorrow morning through the WhatsApp groups, Telegram, and mail through thing, and you can join it. Tomorrow, there is an excellent session, 2 o'clock, by the Renuka Murali, Chartered Accountant from Madras. So she is going to introduce about the total about GST. 2 o'clock. Thank you. Thank you once again, and good night.
Sir.
Ah.
Some people are having some disturbance, sir. They are writing on what do you call desktop, etc., etc.
ఇవాళ ఏం లేదు కదా.
Well, I find it one thing, sir. One అంటే శేఖర్ సార్ దాంట్లో ఇట్లా లైన్ తీసారు పై నుంచి కిందికి.
అదే నాకు కూడా ఒకటే లైన్ వచ్చింది, చూద్దాం మళ్ళీ అంతే. డెఫినెట్ గా విల్ టేక్ యాక్షన్. We'll recording it now. You are saying already some names.
Already today also I find one person.
Yeah, you will see. If they are continuing same thing, we'll see what is going to be done.
Okay, immediately I removed.
Yeah.
And also participants, don't switch on unmute your video and audio. It will give some bad impact to the speakers. They feel some inconvenience, so that you don't do such kind of things.
Yeah, that is okay. I think most of them are serious participants only.
They are good learners.
We'll see, because they are listening patiently. There is no problem at all. Right, Venkatesh, I'm leaving.
Okay, sir.
Hello, sir.
Dear participants, those who want to complete the process of that feedback filling and attendance, complete immediately as much as possible. Dear participants, within 1 minute, I'm going to close Zoom. Okay, those who want to complete feedback, do it immediately. The PPTs will be shared when speakers are shared to Ravi sir or Sandhya madam. Okay, sir or madam will be shared in the WhatsApp group.
Hello, sir. Hello.
Tell me.
Sir, నేను day 1 feedback చేయలేదు.
ఇంతకుముందు సార్ అదే చెప్పాను కదమ్మా.